Okay, so guys, today value added tax, inshallah, which is a very important module. So we will define what is value added tax. We will identify the, understand the executive regulations as well, various types of supply, what are taxable, deemed supply, etc., and a little bit about tax procedures and executive regulations. So, Mr. Mohan, let me ask you, have you already, gone through VAT?
Yes, sir, but practically I work, but filing and all will do other divisions, sir. We are only calculating, we are doing
Hmm.
how much. That filing and all will do other department.
Right, right. So, it is a consumption tax. So, and it deals with the supply of goods and services. So when we say supply of goods and services, it is a bigger terminology, supply, than just revenue. Because in certain cases, goods and services may be supplied, but we might not book a revenue against those. For example, some provision to staff or some other things for that matter that may be treated as supply under the VAT, but as such a company might not book revenue against it. So in the end, if you really think about VAT, it is borne by consumer, end consumer. So and it is a tax that is applied across the supply chain, from the producer to, in case of crops, from the cultivator until the producer, manufacturer, and then distribution, and then retail, and then naturally until the consumer. So that's the end point of it. Naturally, VAT liabilities must be known, otherwise there can be challenges that might be faced. Now, originally, the decree that came was in 2017, and that was VAT decree law number 8. But are you guys aware that later on another decree came for the VAT law? Are you guys aware of this?
Mhm.
There was another decree later on which which amended the original decree of 2017. However, nothing significant has changed. So let us get to know various uh, concepts in the VAT law. So where they have mentioned VATA, that means VAT. I think they have treated it as an act. That's why they put an A at the end, VAT Act. But we will not call it VATA because it is a decree law, not an act. So, but let us first of all understand what is VAT. It is a tax imposed on the import and supply of goods and services at each stage of production and distribution, and it includes deemed supply as well. What is the meaning of the word deemed, Mr. Mohan?
Deemed, assumed, like,
Assumed or seen as a supply, right?
yeah, yeah,
Okay.
yes.
Now, we did talk about GCC states. So I believe we know which are the GCC states, right? Ramsha, how many GCC states are there?
I guess 7.
7 or 6? Can you take the
It,
names, please?
it's Saudi, UAE, Qatar, Oman, Kuwait, Bahrain. Yeah, 6.
6. Now, these are GCC states. Now, what are implementing states? So implementing states are those states which have already implemented the VAT law. Okay.
Okay.
Mohan, how many
Yes, sir.
states in your knowledge have already introduced the VAT law in GCC?
Like Oman is there, sir. UAE,
Okay,
and
UAE
Bahrain.
has. Okay, which are the first two states that implemented this law? That in 2018. From 1st January 2018, the law was implemented in first two states. Which were those?
Saudi,
And
and I think Qatar, sir.
Saudi and
Or
UAE.
Bahrain. UAE, okay.
You're in UAE and you don't know that. So it
No,
will.
I recently came, sir. That's why.
Saudi and UAE are the first two states that
Uh-huh.
implemented the VAT law. Immediately after that, next year 2019, which state implemented that law?
Bahrain.
Bahrain, correct.
Bahrain.
Okay, so three states. Then there was a gap. 2020, no one implemented. COVID also came, I think. Then in 2021, one more state implemented it,
Oman, huh?
Oman,
Oman.
in
Yes.
2021.
Yes, yes, I know.
So in total, four states. What about Kuwait and Qatar?
It's,
They have not
it's like
implemented it
that.
yet.
Yeah.
Okay, they have
Okay.
not. Now, let us talk about the basic fundamental concepts because we will read again and again or hear again and again about goods and services. What are goods? Physical property that can be supplied, including, this is a very interesting angle, including what? Real estate, water, all forms of energy, meaning electricity, etc. All of that is considered as goods. Now, a funny but very interesting and correct definition. What are services? Anything that can be supplied other than goods. So whatever is not goods and can be supplied is services. Okay, easy. Now, imports, arrival of goods from abroad into the states or receipt of services from outside the state. Okay, so if you are here in UAE and somebody is providing you some services from India, this will be treated as import of services. Importer, with respect to importing of the goods, the person whose name is listed as the importer of goods. We call it importer on record. On the date of the import for customs clearance purposes. With respect to services, it is the recipient of those services. When you're receiving services, no customs or anything comes into play, right? So it will be self-assessment based thing. So FTA has to rely on the person receiving the goods in case of receiving the services. But in case of goods, yes, customs may be in picture. What about exports? Now there's a challenge. Goods departing the state or the provision of services to a person whose place of establishment or fixed establishment is outside of the state. Wherever the word states comes with a capital S, what does that mean?
UAE.
UAE, exactly. So in case of export, we will read that there are goods that are supplied out of UAE but without export documentation. So for the purpose of VAT law, FTA does not accept those as exports. Does anyone know what is the benefit of exports to the person exporting the goods from UAE or for that matter services? Ramsha, if you export goods or services from UAE, is there a benefit? Mohan?
There would be some.
Jeline, you are there? Jeline, can you unmute?
Sure.
Yeah, do you remember our discussion about export? How much do we charge for export? What percentage do we charge VAT? Exports are zero rated.
Zero,
Zero
zero
rate.
rate.
Zero.
So that's the benefit. When you're selling, when you're making exports, you don't charge the customer. But you can claim the input VAT. That's the best part.
Yes.
Okay, concerned goods and concerned services. What are those? Goods that have been imported and would not be exempt if supplied in the state. These are concerned goods. And concerned services, services that have been imported where the place of supply is in the state and would not be exempt if supplied in the state. So this is concerned goods and services. Importing, basically these two terminologies are for imports. Business. This definition we have, I think, read before. You may have read before. What are the key terminologies to consider? You guys can see the screen. What are the three key factors initially mentioned here?
Regularly, ongoing
Regularly and
basis, independently.
And
independently.
independently. Three things. Business is something, it is an activity which is conducted regularly, which is conducted on an ongoing basis. And third thing, independently. So regularly would mean that there is a repetition pattern. Ongoing basis means the company is not a very short one day job. It is an ongoing, it's a going concern. It is more aligned towards the going concern concept. And third, independence. So when we talk about independent, what does that mean? Anybody can tell me? So is an employment independent activity?
No independent employment
It
isn't.
employment is not. So if someone is receiving income from employment, that will not be seen as supply because that's not an independent activity. Okay. So those revenues which people earn in an independent capacity as service providers, as sellers, etc. Those are that will be treated as business by any person. It can be natural or legal person in any location, such as, and the types are also identified: industrial, commercial, agricultural, professional, service or excavation activities, etc. And it can use tangible assets, it can use intangible assets. Financial investment is not provided as an example of continuing business activity. Persons can be natural person or legal person. Some of the definitions we are going to talk about. What would be a taxable person? A taxable person, key point, that person is
Registration.
either already registered or required to
Required to
register.
be registered.
Required to be. That's a taxable person. What is a taxpayer? Any person obligated to pay tax in the state. That's a taxpayer. Whether a taxable person or end consumer. So end consumer is also a taxpayer. Remember this point. So for example, when you go to Carrefour to buy grocery, right? Do you pay tax on that?
Yes.
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 So that makes you a taxpayer, correct?
Yes.
Correct.
Yes. Okay. Tax registration. A procedure according to which the taxable person or his legal representative registers for tax purposes at the authority, meaning Federal Tax Authority. This is a registration process. What is the outcome of the registration process? Can somebody tell me? What is the outcome of the registration process? At the end of the
Get
registration
registered,
process.
we get a number.
Yes, we get a
Registration.
tax registration number, TRN, a unique number that is issued by Federal Tax Authority. Okay. As the name itself suggests, registrant. What would be a registrant? Those
Person
people,
who has
those
The
person,
registered.
taxable person who has been issued a TRN. It's a
Yeah.
registrant. What is a taxable trader? A taxable person in the implementing states whose main activity is the distribution of water and all types of energy as specified. So that's a unique definition. Taxable trader, ordinarily, it would come to mind that any person who trades. No. Distribution of water and energy. That's it. Okay. Now, tax return, again, it has a common sense meaning. The same return that we file with the Federal Tax Authority, VAT return. So that's called a tax return, specified format. Tax submitted by a taxable person in accordance with the form. Format is already there in the in the portal. in which so there is a periodic tax is paid in there. All that is received or expected to be received for the supply of goods or services. So we basically write all the supplies, how much revenue was it, how much tax we collected, how much tax did we pay to the suppliers, and the balance we submit as the net VAT payable. Okay. Some of the definitions, Jeline, how many types of supply are there?
Three.
Huh?
Three.
What are those three types?
Zero rated supplies,
Mm-hmm.
standard supplies, and exempt.
And exempt.
Exempt.
Exempt, correct. So actually exempt supply is there, and then under the taxable supplies, two categories are there: standard rated supplies and zero rated supply.
Zero rated.
And there is another additional type that has been mentioned here, which is deemed supply. That means sometimes we may not book revenue against it, but we have to, we have provided certain things, free samples, etc. These will be seen as deemed supplies. We will look at this definition in more detail later. Now, what is the input tax? Jareen, whom do we pay input tax to? Customers or suppliers? Input tax. Mohan?
Suppliers, sir.
Suppliers. Input tax is paid to suppliers. Tax paid by person or due from him when goods and services are paid to him. Simple. It's a very easy to understand concept. This amount is deducted from. What is output tax? Jeline, what is output tax? Ramsha?
Output tax is the tax that supplier pays, like when
Supplier pays. Supplier pays.
no,
Okay, Mohan, what is output tax?
Actually, we are paying that how much sale we done, we have that much we have to collect from end customer, we are paying to government.
Uh,
After deduction of input tax.
yeah, but
Net tax, that is output tax means whatever we are collecting, that much is output tax.
yes, that's
Net
the
tax
answer.
means
We can't say, we cannot include the net or the input tax into the definition of output tax. Answer is very simple. The amount of VAT collected from customers. That's it.
From the customer.
That is output tax. Now, what is recoverable tax? Can somebody tell me? Jeline, what is recoverable VAT? You remember? Can you recover tax which corresponds or relates to exempt supplies? Just today we did an exercise. Okay. So can somebody tell me what would be recoverable tax?
actually we purchased from with VAT and we sale from without tax. That input tax recovery, sir.
Input tax recovery, correct. But please understand that whatever amount of input tax we paid to our suppliers, in certain situations, we cannot claim all of it. Some amount of that input tax we cannot recover. We cannot deduct out of the output tax when we are submitting our return. That amount is expensed out. It is a loss for us. The remaining amount that we can recover, that we can deduct from our output tax, that is the recoverable tax.
Okay.
You get my point? Understood?
Yeah.
Amount that were paid and may be returned by the authority to the taxpayer. That's recoverable amount of tax. Excise tax, it is again another type of indirect tax that is imposed on specific goods, specified goods. Okay. That's called excise tax. So there is high excise tax on cigarettes and alcohol beverages, and then there is normal excise tax as well. Okay, tax group. What exactly would be tax group? So we have taxable persons. When two or more taxable persons combined and do a single registration with the Federal Tax Authority, they are seen as one taxable person. That is what is meant by a tax group. Two or more persons registered with the authority for tax purposes as a single taxable person. That's called a tax group. What is a tax period? A specific period of time for which the payable tax has to be calculated. So in our cases, tax period can be the quarter itself. Okay. Because usually in UAE tax VAT returns are filed on a quarterly basis. Okay. What is tax invoice? That's an easy question. If you are a registered person, if you are a taxable person, you have a registration number, and then you raise an invoice to your customers and put the VAT amount and TRN and all details onto it. That's a tax invoice, because that invoice is in a prescribed format, and it can be electronic document also. A tax invoice can be paper based, a tax invoice can be electronic as well. Clear?
Yes.
Acha. What is a credit note normally? Normally, what is it? Accounting question, not VAT question.
Sales returns.
Sorry?
Return of sales that we are raising tax credit note.
For return
Like
of sales.
we are selling 100 dirham, suppose example. In that customer return some 50, some 20%. That 20% against we are raising one credit note.
Okay, so that's an example of a sales return.
Yeah.
Hmm. Okay. Can there be other circumstances other than sales return?
Can be issued in the case of error as well, like
By mistake, we raised an invoice which was higher than it should have been. So we can raise a credit note to bring the invoice to its correct lower amount. That's a credit note. But then what is a tax credit note? So it is that credit note which is raised by a taxable person, and it meets the requirements of the VAT law. There should be proper, there are conditions for, all information should be prescribed. The heading should be tax credit note. TRN should be mentioned, which invoice it is affecting, that should be identified. All the required information should be provided on that note. So that becomes a tax credit note. So that's the opposite of the invoice. Okay. Now we're coming to the concept with some certain other concepts, for example, residence as well. But before that, let us go through some of the definitions. What are government entities? It has a similar concept to corporate tax. Federal government, local government, ministries, all of these are government entities. So various government authorities, agencies, etc. Okay, public institutions of the state. Those are government entities. What would be the mandatory registration threshold for the purposes of VAT law? Can somebody tell me? Okay, forget about let's ask a simple layman question. What is the meaning of the word threshold, registration threshold?
Means some limit it will be there. Like this limit you have to cross means you have to do registration.
Correct, absolutely right.
Revenue.
हाँ बिल्कुल. Correct answer. Threshold is a limit. Registration threshold is that limit which requires registration. But mandatory means compulsory,
Yes.
right? It is now it is required by law that you register. So can somebody tell me that under VAT law, what is the actual mandatory registration threshold in dirham terms?
300,000.
300 something.
375.
Very good, Jaleen. 375,000 dirhams. So an amount specified in the executive regulation of the decree law, if exceeded by the value of taxable supplies or anticipated to be exceeded. Actually not exceeded, but it is anticipated to be exceeded. There is evidence that we will cross this limit. When we even have the evidence available, we should register. The supplier shall apply for tax registration. This threshold is important because those entities with taxable supply amounts in excess are required to register. This, you know what is the most important part in here? This
And
anticipated to be registered. Meaning if anticipated to exceed the amount. Meaning you started operations or it has only been two months, 3 months, but you know that easily you will cross this limit. Then what do you have to do? You have to register for VAT. Okay.
sir, one question, sir.
Hmm.
Actually, suppose example 2025, my business is crossed 375,000,
Okay.
375,000. Next year and all, only 100,000 is there. That
So
time, once registration is done, then future years it will be less also you have to file or any other thing it will be there.
hold this question. This question will be answered after the second point. What is the
Okay.
second point here? Voluntary
Voluntary.
registration threshold. You know what is voluntary registration threshold?
Yeah, it was
We only, without
187.
crossing the limit, we can voluntarily we can go and register.
So
No
what
need
is the
to.
threshold? What is the threshold?
It was 187K, I guess. Not sure.
187,500.
Half.
Exact half of 375,000 there.
Hmm.
This voluntary registration threshold is half of the mandatory registration threshold. Got it?
Yes.
187,500. Now your question, Mohan. If a company is required to register mandatorily now that you have to register for the VAT, 375K
Yes,
has been breached, right?
yes,
So you
yes, sir.
registered, fine. Next year, it is below 375K, but you're still above the voluntary
Not only
registration.
next year, further years, all years, like,
You have fallen below 375K,
yeah, yeah.
but you're
And
still
below
above the
185, below 187 also.
if you go even below 187K, then the mandatory deregistration will happen.
Okay,
And if you know that your revenue has fallen even below 187,500 dirhams, then by law you are required to deregister. You
okay,
cannot stay registered. If you do not deregister, there is a fine. I think it is 10,000 dirhams.
okay.
Now, there are two concepts which are close, but we have to read them because they are similar to what we read in the corporate tax law as permanent establishment. Okay. So, but there is a difference between the two concepts. We will understand. First point is what? Place of establishment. What did I say? Place of establishment. What is that? The place where the business is legally established in a country pursuant to the decision of its establishment. Meaning this is basically the place of incorporation. Okay. But the use of the word establish indicates that it is slightly larger than incorporation. It can be even a branch as well. But having said that, let us read the fixed establishment. Any fixed place of business other than the place of establishment in which the person conducts his business regularly or permanently. that would be seen as a fixed establishment, where sufficient human and technology resources exist to enable the person to to supply goods or services, including including branches. Okay, so if since the law has clarified that branches are meant as fixed establishment, then the only logical meaning of the place of establishment is the place of incorporation. Is this point clear to you guys? The difference between the two definitions? Ramsha?
Can you please repeat it once?
Okay. See the wordings of fixed establishment. Any fixed place of business other than the place of establishment in which the person conducts his business regularly or permanently and where sufficient human technology resources exist to enable the person to supply or acquire goods and services, including the person's branches. So what does that mean? Fixed establishments are fixed places of business, including branches.
The branches.
Branches is an example of fixed
Fixed
establishment.
establishment.
So what would the place of establishment then mean? Legally established. So we have to read this as legally registered or incorporated. So this is the birthplace of the business.
Okay.
Okay. So in UAE, mainland is there, free zones are there where companies get registered and obtain their certificate of incorporation. Got it? So here just for memory purposes, remember place of establishment is as place of incorporation and fixed establishment as the place where the branches are formed. Easy to remember. Okay. Now, place of residence, the place where a person has a place of establishment or fixed establishment, meaning it is either incorporated in that place or it has a branch or other permanent establishment in that place. Both will be considered as place of residence. Place of residence includes both of the above definitions. Clear? Non-resident. Any person who does not own a place of establishment or fixed establishment in the state. So that person is not incorporated in the state. That person also does not have a fixed place of business in the state or a branch in the state. So that person will be seen as non-resident. Clear?
Yes.
Mohan, is it clear up till now?
Yeah.
Okay. Now we're coming to related parties. Two or more persons who not separated on economic, financial or regulatory level, where one can control the others either by law or through acquisition of shares or voting rights. This concept is relevant for two or more entities wishing to form a tax group. So that's a very interesting scenario. What is the tricky part here? This one, the one that I have highlighted, where the one person controls the other either by law or through acquisition of shares or voting rights. So one holding company will have shares or voting rights in the subsidiary, right?
Yes.
So holding company and subsidiary will be considered as
Related parties.
related parties. What if there is no parent and subsidiary relationship, but there is a management company? A third party management company was engaged, and that management company the contract that was signed with that management company was so strongly worded that the main company could not do anything, could not take any operational decisions without the approval or without the say-so of the management company. Do you think that would constitute control? Yes, it would.
Yes.
Right? So in that case also, the company will be economically controlled by the management company, and these would become related parties. Clear? Okay, capital assets. These are business assets designated for long-term use. There is further, I think executive regulations have also identified the value of the capital asset as well. It is quite big. I think 5 million dirham is the value of capital assets. These are usually larger, 5 million dirham and above. A capital asset scheme, it is a scheme whereby initially recovered input tax is adjusted based on the actual use during a specified period. So, you were making a building, right? That's a big thing, right? Huge. So there will be a lot of input tax that you will pay while constructing the building. So the law allows you to adjust or claim the input tax over a longer period of time. In case of buildings, it is 10 years. For other capital assets, maybe some plant and machinery or something, it is 5 years. So we'll see, we'll read that later. Administrative penalties, that's an easy one. If you do any non-compliance or anything, like you did not pay in time, you delayed in registration, etc., you filed incorrect tax return, all of these are administrative violations, and you will have to pay money for that. Those are called administrative penalties. Assessment of administrative penalty is basically a decision issued by the Federal Tax Authority that, okay, we have analyzed your request. Everybody says, please remove my penalty. But then finally authority reviews the case and issues a decision. That's the administrative penalty assessment.
Sir, we'll read about more in capital assets, sir.
Yeah,
Further.
yeah. We will read
Okay.
about capital. There is
Okay.
full-fledged section in executive regulations as well.
Okay.
Custom legislation, federal and local. We're still in second part, my dear. There is too many things coming ahead, inshallah. Even if it is not covered, I'll tell you where to read it from. It is there in the executive regulation. Do you have executive regulations of VAT?
No, sir.
You don't have? Okay.
No.
What about you, Ramsha? Do you have?
Yes.
Would you be so kind to share it with him?
Yeah. I'll share.
And the decree law as well.
Okay.
Yeah, and the latest version of the decree law, not the 2017 version. There's a let me see if I can share with you guys. Okay, I think I shared both things today itself. Let me see. I just shared today both okay, so this is first the decree law. Okay, this is the later second, like the new version of the decree law. Okay. And another thing, executive regulations. So guys, please save these because these are, updated ones.
Okay.
Okay.
Sir,
Right.
I need to know if we purchase from suppose vehicle will purchase from 100,000, they will charge VAT. That charge we can include into fixed asset cost, or we can otherwise we can claim input tax credit.
You you can claim input tax credit. Even for capital, even for capital expenditure, you can claim.
Okay.
But capital expenditure is an accounting concept. Capital
Yeah.
assets is a VAT concept. In order for something to be capital asset, it has to be 5 million dirhams or more in terms of
Okay.
value.
Actually, in my office, in old office, they are telling no need to claim that it to include into cost.
No, that's wrong. You can claim it. For
Okay.
fixed assets, if you have purchased fixed assets and you have paid VAT, you can claim the VAT.
Okay.
Yeah.
That fixed asset value. That time we have to show as without VAT or with VAT, sir.
No, where do you want to show?
No, in account books of accounts.
So if see in
For depreciation
this
purpose,
this is
everything.
a very simple accounting question if you really think about it.
Uh-huh.
If you what will be your accounting entry? Tell me. if you know that you can claim input VAT, so how will you book the original entry?
Yeah, cost will put and input tax credit will put, then I'll put
Input tax
separately.
asset.
VAT portion will put separately.
Yeah, input tax asset you will create 5 dirham. Cost of the
Yeah.
asset you will create as 100 dirhams, and
Uh-huh.
whatever payment or liability that will be
Yeah.
there, 105, right? And that
Yes, yes.
5 dirham of input tax asset that you created, that you will recover later on. You will credit that and debit the VAT control account or output VAT account, as the case may be. So naturally the balance will be net of
Because I
VAT.
am asking that this they are what they are doing. The 105 they are showing as fixed asset like that they are showing. That's why I'm asking.
So
This is
so
wrong or what?
so
That's it.
if because of the lack of knowledge they were doing it, then it is incorrect. But let
Huh.
me tell you that claiming input VAT is an optional thing. So I mean that's
Okay.
not a non-compliance per se. So I mean it's like voluntarily letting go of the claim, whereby you could have
O-
claimed it. You get my point?
Okay. Okay.
So if you want to claim it, then you can claim it. But if somebody says that I don't want to claim, that's a different story. It can happen because of
Okay.
lack of knowledge of VAT law, but it will not damage you as such because it's not a non-compliance with the VAT law. Okay.
Okay. Okay.
So now coming to the rest of the things, custom legislation, federal and local legislation that regulates custom in the state. Uh, that's so it's basically custom law, right? You're aware of the customs law, right?
Yes.
So designated zones. How many designated zones are there in the UAE?
24.
24. And how many free zones are there in the UAE?
Oh,
Please know that more than this.
Around 50. And
41.
yeah,
Oh.
50 plus minus whatever exact number. But and are all designated zones free zones?
No, sir.
Oh, Mohan
Yeah.
says that all designated zones are not free zones. Ramsha, what is your
All
view?
all designated zones are free zones, but all free zones are not designated zones.
That's the correct answer. Mohan,
Okay.
designated zone is a type of free zone.
Okay.
You understand?
Yeah, yeah.
So free zones is the superset, larger set. Of that larger set, a smaller population is designated zones. Clear?
Yeah, yeah.
Now, what are those designated zones? So basically, designated zone is a geographically demarcated area. Okay, there is a physical location of those zones. And in those zones, customs procedures apply. That is why we call them designated zones. Is this point clear? So Mohan, what is the difference
Okay.
between designated zones and other free zones?
Designate compared to this, like free zones means more, like I
I
don't know
just
how
gave
to.
the answer and
Yeah,
after that
yeah.
I asked the
Yes,
question.
yes,
Can you
yes.
recall what I said? What happens in designated
Yes,
zones?
it's more powerful.
No, wrong. That's not the answer. You did not hear me, I think. Okay, so Ramsha, you tell me.
In designated zones, there are specific custom laws that applies.
Customs procedures apply.
Procedures, yeah.
In designated zones, Mr. Mohan, customs
Okay.
procedures apply. But in free zones, customs procedures may not apply. What are those key procedures? In designated zones, goods cannot move freely in or out of there unless a customs declaration is prepared. Okay? And
Okay.
inside a designated zone, there are bonded warehouse subject to custom law.
Yeah, yeah.
But in other free zones, nothing of the sort is there. So have you read or have you visited any free zones lately, Mohan?
I'm working in free zone only, sir.
Which one?
Sharjah Airport free zone.
Sharjah Airport free zone.
Yes,
Okay, so when you're entering Sharjah Airport free zone, do you or other people have to take a pass from the gate?
yes, yes. We have ID card.
You have ID card because you're working there, but others have to take a pass, right?
Yes,
Why?
yes, yes.
Because there are customs procedures. There is no free movement of goods
Yes, yes, yes,
or
yes.
even personnel. Sharjah Airport free zone is a designated zone. Okay,
Okay.
and also it is a free zone. Okay, all designated zones are free zones, but all free zones are not designated zones. Other than Sharjah Airport free zone, any other free zone have you visited ever?
No, sir.
Okay, have you heard about DIFC?
Yeah, yeah.
So that is that a designated zone or other free zone?
Not entered, but I think it's
It's a
free zone.
designated
Free.
zone. I went there.
DIFC. Why it's a
Yes, I
financial free zone? क्या हो गया? It's a
Yeah, yeah.
financial free zone. It's not a designated zone. This is purely for financial industry, banks, insurance companies, investment companies, and all that, holding companies. So quite a few free zones are non-designated zones. Okay, DIFC, ADGM, both are non-designated free zones. Only so you have a list you can refer. Some of the well-known designated zone names other than Sharjah Airport Free Zone. Can you guys tell me which one is the most famous designated zone of UAE?
Jablali free zone.
Jabal Ali Free Zone, Jafza.
Yes.
Okay. Uh, the biggest one is Jafza. Then
Yeah.
there in Abu Dhabi there is called Kizad. Kizad is also a very famous designated zone. Similar other designated zones are there. Anyways, voucher, it is an instrument that gives the right to receive goods or services against the value stated therein. So we get a lot of vouchers, right? Right? Amazon vouchers are there. Other vouchers are there. So you can use those vouchers and that the VAT treatment we are reading about the vouchers. So any instrument that gives the right to receive goods or services against value stated thereon, or the right to receive a discount on the price of goods and services. Vouchers do not include postage stamps issued by the Emirates Post Group. Okay, activities conducted with sovereign capacity. Name itself suggests something. So what would you think the means? Activities conducted by government entities in their sole competent capacity with or without consideration. These are activities conducted by sovereign capacity. Clear, guys?
yes.
Okay. So VAT is charged on every taxable supply and deemed supply made by a taxable person, together with every import of concerned goods, except for those transactions which have been specified in executive regulation. So basically, VAT is applied on everything except exempt goods services. VAT is charged on any supply of goods or any supply or import at the rate of 5%, which is the standard rate. And it is identified in Article 2 of the VAT, 2 and 3 of the VAT. Okay. Responsibility for paying VAT is on the taxable person making or any covered supply, importer of the concerned goods, registrant acquiring any crude or refined oil, unprocessed or processed natural gas, or any other hydrocarbon. So this is, these are the persons who are responsible. Taxable person making supplies, importers, and registrants
Understand.
of hydrocarbons, basically. Now, what is supply? Since VAT is chargeable only on supply, uh, goods shall be treated as having been supplied for VAT purposes at the moment when the ownership of the goods or the right to use the goods is transferred to another person. Okay. When the contract was entered into between two parties who involve the transfer of goods at a later time, contract to sell. Okay. Both scenarios. Sales contract and contract to sell. Contract to sell is a future has a future connotation to it. In relation to services, every supply, not a supply of goods, is treated as a supply of services, including any provision of services specified in the executive regulation. So anything which is not goods is services. However, transfer of whole or independent part of a business from a person to a taxable person for the purposes of continuing the business that was transferred. So ongoing basis transfer as a going concern, that will not be treated as a taxable supply. Is this point clear? So what could be a scenario where a business was sold but not on an ongoing, not as a going concern? Can somebody tell me? Can there be a situation where a business is sold not as a going concern? By the way, there's a whole industry on it. We call it strip sales. Do you know what is strip sales? When you sell a business so that that business can be broken down into pieces, all assets, etc., can be sold off. That's a strip sale. So that if that is the case, then it will be seen as a taxable supply. Okay, if a supply of goods or services was conducted through an agent which acted in the name of and on behalf of a principal, which is a disclosed agent, meaning you were clearly identifying, look, I am doing this on behalf of this person, this seller, then the supply is deemed a supply by the principal rather than the agent. So if it is a disclosed agent and for his benefit. However, if the supply of goods and services was conducted through an agent acting in the agent's own name, undisclosed agent, then the supply is considered to be a direct supply by the agent and for the agent's benefit. Very important point. Is this point clear to you guys?
Yes, sir.
So, for example, in all the city centers, Dera City Center, Dubai Mall, etc., there is a shop called iStyle. Have you heard about the name? That shop, iStyle, sells only Apple's products.
Apple.
Okay. iPhone, Mac, this, that, iPods. If that shop does not disclose that we are making the sales on behalf of Apple computers, if they don't disclose it, then what will happen? All the sales will become the responsibility or for the benefit of iStyle directly. But if they have clearly identified that, look, we are selling it on behalf of Apple computers, then the sales that happen, those sales will not be seen as the sales of iStyle. They will be seen as the sales of Apple computer. That it's a huge difference. Is this point clear? Any confusion?
Yes.
Okay. Transactions that may constitute a supply of goods are described in Article 2 of the Executive Regulations, and supply of services are in Article 3. Let's read Article 2 and 3 of the Executive Regulations. Transfer of the ownership of goods or the right to use them. We read this, but still. Shall include transfer of the ownership of goods under a written or verbal agreement, or a transfer of ownership for a consideration in a compulsory manner pursuant to applicable legislation. In short, whenever the title to property in the goods or right to use the goods is transferred, that's when supply is made. So what is the difference between title, transfer of title, or transfer of the right to use? What is the difference? Transfer of ownership is one thing. Right to use, ROU, that's a different thing. Can somebody tell me what is the difference? Why right of use? I'm asking right of use. Anybody?
Right of
Rent,
use,
हाँ, rent
the
a
risks
rent a
and
car,
rewards are not transferred.
हाँ, okay. Like rent a car. What about rent a car business? You rent a car, but is that car your ownership?
No, it just gives
No.
you the right to use.
That's an example of right of use. You go into a hotel apartment and you start living there. Even on a permanent basis, you're living there. Does that make this apartment your property? It doesn't. It is still right of use. But if you bought that apartment, yes, then it will become transfer of ownership. Is this point clear?
Yes.
Yes.
So this is an example of a right of use versus transfer of ownership. Entry into a contract between two parties causing transfer of goods at a later time. Forward sale. You see this? You go to a tailor shop. What do? Look, I'm bringing you the cloth. Can you please, create a suit? Or you go to a tailor shop and you don't bring the cloth, but you identify the cloth and you say that, okay, can you please stitch a suit out of this? The tailor says, okay, after 10 days you can come. Is that a sales contract or a contract to sell?
Oral contract.
Sorry,
Oral contract, sir.
bhai, there are two types under the Sale
Sales
of Good
contract.
Act, Sale of Goods Act. There are two things. Sales contract, which means a transaction is complete. You have paid the money, you've gotten the consideration against it. That's a sales contract. And a contract to sell means that you are entering into a contract asking the supplier to do something in future, and that
Oh,
transaction will be complete in future. Tailor is an example of this. So what does that make? Sales contract or contract to sell? The tailor example.
Contract to sale.
contract to
Contract.
sell.
Contract to sell.
Mm.
Okay, contract to sell. So,
Yes.
forward sale agreement. It will also be a supply of goods. Okay, so the tailor can issue you a tax invoice saying that please pay me in advance and I will do this. So he can put tax on it. Okay, uh, so that's one thing. Let's look at it. Look at the services also. Granting, assignment, cessation, or surrender of a right. So you had a right and you granted it. That's an example of a service, I believe. Making available of a facility or advantage. Uh, Not to participate in an activity or not to allow the occurrence. So sometimes refraining from doing something is also an example of supply of service. Transfer of an invisible share in a good. Transfer or licensing of intangible rights, for example, right of authors, inventors, artists. These are all services. So basically, supply of service, it may constitute a supply of services as set out in Article 3 of the Executive Regulation. Supply of goods has been addressed in Article 2. Okay. Now we are coming to the concept of deemed supply. In certain cases, transaction may be deemed to be a supply even though it would fail to qualify as a supply under the first principle. Examples include supplies constituting the whole assets of a taxable person or a part thereof, except when the supply was made without consideration. For example, a gift.
Huh.
Best example is gift. Therefore, supply by the gift is not a supply. Also, the transfer by a taxable person of goods constituting a part of supplier's business assets from the state to another implementing state. You are simply moving the goods, transferring the goods from UAE to, for example, Saudi Arabia, and to another company that is also owned by you, that will still be, it will be seen as deemed supply. Okay, you're not although it is not against a consideration, or from the taxable person's business in an implementing state to his business in the UAE, that would still be seen as a deemed supply, except in the circumstances in which the transfer is considered to be temporary under the customs legislation, or is made as a part of another taxable supply of those goods. I mean, you're bringing those goods to UAE to send further to China, for example, or you're yeah. So temporary, a transit sale. VAT law makes certain transactions exempt from being a supply, with the most important of which being where the input tax is not recovered for the related goods and services. So, though these are indications of exempt supplies. You cannot recover the input tax. The supply itself is an exempt supply. It has been identified. There is an article actually in the VAT decree law on exempt supplies. So you can refer to that article. It will, and in the executive regulations also there is an article which indicates, I think, uh, no, Article 42 is on interest, but specific articles are provided in decree law as well as executive regulations of what is exempt supply. Examples are interest, examples are residential building supply. Recovered input tax has been adjusted for the goods and services pursuant to the capital asset scheme. So it has been fully adjusted for the capital asset scheme, so it will no longer be within the scope of tax. Value of supply of the goods for each recipient of goods within a 12-month period does not exceed the amount specified in the executive regulation threshold. So you have not even reached that point where you have to register for tax during the 12 months. So if that is the case, then you're still out of the scope. Total output tax due for all the deemed supplies per person for a 12-month period turned out to be less than the amount specified in the executive regulations. So we'll have to refer to executive regulations article 12 to gain a deeper understanding of that. I think it will come ahead. Practical example of transactions which may constitute exceptions to the deemed supplier rule have been provided in the executive regulation, where the input tax on the relevant goods or services is not recovered. That's a big condition criteria for exempt supplies. For exempt supplies, you cannot recover input tax. Where supply is exempted, I mean, the nature of supply has been already specified in the decree law, and those are interest income or supply of residential property, etc. These supplies are already by default exempted supplies. Where the refunded input tax on goods and services is amended according to the capital asset scheme. So refunded input tax on goods and services is amended according to capital asset scheme. If that is the case, again, that will make it out of the scope of VAT. So that will also become that this will also not be seen as a deemed supply. What we are reading is the deemed supply rule, exceptions to the deemed supply rule. Practical example of transaction which may constitute exceptions to the deemed supply rule, where the value of the supply of goods for each recipient within the 12-month period does not exceed 500 dirhams. So, you, for example, gave free samples or gift to your customers, and it does not exceed 500 dirhams. So it will not be seen as deemed supply. Why are we addressing all of this? We are addressing it because deemed supplies are taxable, but these exceptions are there. So if your free samples or gifts are within the 500 dirham threshold, then they will not be taxed. But as soon as they go above, then they will be taxed. And the supply made is to be used as a sample or a commercial gift, where the total output tax payable on all deemed supplies for each person for a 12-month period is less than 2000 dirham. For each person, the deemed supply is less than 2000 dirham during a 12-month period, then it will no longer be seen as deemed supply. Okay, so this is all addressed in Article 5 of the Executive Regulation. This usually deemed supply cases are very rare actually. They don't appear in the bulk of our businesses. So now we're coming to mandatory registration, which is addressed in Article 13. Mandatory registration is required for each person who has a place of residence in the UAE. Question: what is place of residence? Can somebody recall?
Place of establishment or a fixed establishment.
Correct. There were two meanings of the word place of residence. It was either place of establishment or the place of fixed establishment.
Fixed establishment.
Yeah. So, and what was the difference between the two, Ramsha?
Place of establishment was the place of incorporation, and fixed establishment is like you can say branches of the
correct.
business.
Very good. So, mandatory registration is required for each person who has a place of residence in the UAE. Whether you have a branch in UAE or you have a company in UAE, you have to register. Or in another GCC member state and is not already registered for tax. So, if you have a place of residence either in UAE or in another GCC member state, and it is not already registered for tax, then you have to register in UAE. The person shall register where the total value of all supplies exceeds the mandatory registration threshold over the previous 12-month period. First of all, so we always look at retrospectively. So if let's say we are sitting in the month of February, okay, so what we are going to do is we are going to consider the supplies of February to date, and we are going to look at the 11 previous months and calculate the total amount of supplies. If it exceeds the mandatory registration threshold 375k, if it is already more than that or reached that point, then we are required to register. That is one criteria. Okay. Or where it is anticipated that the total value of all supplies will exceed the mandatory registration threshold in the next 30 days. So what we have to look at another thing. If we are sitting in the month of February, let's say this is the end of February, okay, and we have just obtained a contract which will a confirmed contract, signed contract, which means that in the month of March, our overall supplies for the 12-month period, including month of March, will exceed the 375k threshold. Okay, so then immediately we should register. Okay, so that is how we calculate from today until previous 12 months. If we reach 375k, we should register. Or alternatively, from today to previous 11 months, and then add the next 30 days from today. Anticipated supplies. If the total of that is more than 375k, then still we have to register. Does this make sense? Any questions around that? Mohan, did you understand this point?
Yes, sir.
Ramsha, do you have question?
No, I
Clear.
got it.
Okay. Every person who neither has a UAE place of residence nor a place of residence in any other GCC member state and is not already registered for tax shall register for tax if he makes supplies of goods or services, providing no other person is obligated to pay the due tax on these supplies in the states. Sometimes an agent can be there, or other responsible person is there in the UAE, and the person has a registration in Saudi Arabia, for example, and he's making supplies in UAE without any other responsible person who's responsible to deal with the tax affairs, then that person has to register in UAE as well. A taxable person may be exempted from mandatory registration if the business suppliers are subject only to zero rates. So all of your suppliers are zero rated suppliers. You can opt to get you can apply for exemption as well. So what is the benefit of exemption? Then you get an exemption certificate, and you don't have to pay taxes. But what is the loss of this? You are making only zero rated supplies. What is the loss of this? You are making zero rated supplies only, and you applied for exemption, that exemption from the registration. What would be the loss of to the person?
Input tax credit we cannot claim, sir.
Yes, correct. We could have claimed input tax credit, but we will not be able to. Okay. Later sections will discuss the circumstances in which a supply will be zero rated. So usually it is exports. Easier understanding is mostly exports are zero rated. Just one more case I can remember is first supply of residential buildings. That is also zero rated. It should be, there are other things as well, by the way. It should be noted that for the purposes of mandatory registration, the place of residence means the place where a person has this we just discussed. Other than in which the person conducts his business. Okay. It should be noted that place of establishment, this we have read that. Okay. Registration threshold. Okay. We know the answer to this already, but anyways, let's quickly read through. Person shall exceed the mandatory registration threshold and voluntary registration threshold when the aggregate value of, now Ramsha, please pay careful attention to what we are going to read. And Mohan, this is how we calculate mandatory registration threshold. Okay. It is the aggregate of the value of taxable goods and services, first of all, plus concerned goods and concerned services. What was the meaning of concerned goods and concerned services? The word concerned, that indicates what?
Goods that have been imported.
Correct. Goods and services which are imported and which would not be exempt if supplied in UAE.
Yes.
Received by the person. Aggregate of goods and services. So these are expenditures plus concerned goods and services. Whole or relevant part of taxable supplies belonging to that person if he has wholly or partly acquired a business from another person who made the supplies. Whole or relevant part of the taxable supplies belonging to the person if he has wholly or partly acquired a business from another person, person who made the supplies. So there was one person who was making taxable supplies, and now you have acquired the business. So the portion that relates to you, that will that will be considered for the threshold. Taxable supplies made by related parties pursuant to the cases stated in the executive regulation of this VAT law exceeds the threshold. In certain cases, if there is related parties who are making taxable supplies, that also could be a reason for tax registration, because then you would be most probably forming a tax group together with the related party. So what you're doing is parent company's revenue plus subsidiaries revenue, or parent company's expenditure plus subsidiaries expenditure, both together. You will see whether it has crossed the 375K threshold. If it does, then you can form a tax group, both entities. Acha. Excluded from the aggregate will be the supply of capital assets. We will not include capital assets that 5 million dirham or more. We will not consider in the calculation of the threshold. So what are the four things? Taxable goods and services, plus concerned goods and concerned services, again plus the amount of taxable supplies that the business has done, plus related party supplies in case we are forming a tax group. But we don't include the capital assets. It should be noted that for the threshold purposes, concerned goods means this repetition have been imported and services are imported services. Practical application is found in Article 7 of the regulation. Let us have a look at it. Mandatory registration threshold is 375K annually. This is provided in the executive regulations. So this is not inside the decree law, it is provided in the executive regulations. The person required to register for tax must file a tax registration application with the authority within 30 days of being required to register. What does that mean? Means the moment you realize, the moment it has become clear to you that our mandatory registration threshold has already been breached or that it will be breached within the next 30 days. Then the moment you get this information, you have to apply for registration within 30 days. Is this point clear to you guys? It's a very important tax compliance point, and you could do a mistake in case if you hire a client, if you engage a client, and if you don't know whether this client has to register or not, and so these points will matter a lot. And the client, if you do not apply the correct understanding, client will incur a loss. It will incur an administrative penalty for delay in registration. Where a person does not file the tax registration application despite being required by the authority, shall register that authority can also register the person with effect from that date on which the person first became liable to register to be registered for tax. Usually that happens in penalty cases. The authority finds out that the person has not registered. They look at it and they say your registration is active from 1 year before. Authority may impose the penalties prescribed by the law. So there's a new version of this law now, which is tax procedures law. Okay, so 2017 is an older version. The newer version is 2022. We will look at that also. Where supplies made by the person exceed the mandatory registration threshold during the previous 12-month period, the authority shall register the person with effect from the first day of the month following the month in which the person is required to register. The authority shall allot the registration on the first day of the following month when the person is required to register, whether or not the person applies for tax registration or from such earlier date as agreed between the authority and the person. Where a person expects his supplies will exceed the mandatory registration threshold during the next 30 days, the authority shall register the person with effect from the date on which there are reasonable grounds for believing the person will be required to register, whether or not the person notifies the authority of the liability to register for tax. Again, there will be a penalty also imposed in this situation because the person was required to register, but he did not, notify the authority, or from such earlier date as agreed between the authority. So anticipation, if you anticipate to exceed registration threshold, again immediately you should apply for registration within next 30 days. Where a person is not a resident of the UAE and is required to register, the authority shall register the person with effect from the date on which he started making supplies in the UAE, whether or not the person notifies the authority of the liability to register for tax. Non-residents can also be registered for VAT by the authority, and it can be compulsory as well. A taxable person who was late in registering for tax is liable to account for and pay to the authority the due tax on all taxable supplies and imports made by him before registering. So, as I said earlier, authority can apply retrospective taxation. If a person was required to register but he registered late, authority can recover tax, and it will be problematic as well. Why? Because in that case, the authority will look at the revenue as inclusive of VAT. So there will be a reverse calculation done. So, and it will be a kind of a loss to the taxable person. Now we are coming to voluntary registration. So, under the heading of voluntary registration, they have explained some other topics as well. For example, tax group. In order to simplify intra-group transactions, firstly from a cash flow perspective and secondly from administrative perspective, two or more companies can form a tax group. Two or more members of a corporate group which conducts business may register as a tax group if all of the businesses have a place of establishment or fixed establishment in the UAE and the relevant persons are related parties and one or more persons conducting the business controls the others. So these are the conditions of forming a tax group. They should, first thing is, they should be resident, like either a place of establishment or a fixed establishment. Secondly, they are related parties and naturally one under the related party, the element of control by default comes in. One party controls the other party. For this purpose, parties are related parties when two or more persons who are not separated on economic, financial, or regulatory level. This is the definition of related parties that we read earlier. It can be by law or by voting rights and shares, etc. Executive regulation confirms in order to further the administrative simplification, a tax group may select one of its registered members to act as the representative member of the group. And that representative member is authorized to apply to the authority for to register for the tax group. So, in VAT law, formation of tax group is very different from corporate tax law. Later on, we are going to read the same topic under corporate tax. There it is different. In the VAT law, even if there is one individual controlling two companies, that those two companies can still form a tax group. But that is not the case in corporate tax law. Registration of persons. The executive regulation also confirms that the registration of persons as a tax group results in the following. Now, this is very interesting. Businesses are carried out by the members of the tax group are deemed to be carried by one representative member and not by the individual members of the tax group. So there are multiple companies in the tax group, but only one, it will be seen as one fiscal entity. So the representative company will be seen as carrying on the business. Supplies made by an individual member of the tax group to another member are disregarded. They are seen as change of pocket. So intra-group transactions, intercompany transactions, they are ignored. They are not treated as supply. Any supply, taxable or otherwise, by a member of the tax group to a person outside the tax group is deemed to be made by the representative member. So remember this representative member concept. There is company A and company B. Okay, and those two companies have to form a tax. They are eligible to form a tax group. So one of these companies will have to be designated as the representative member. That company will be responsible for the tax group. Is this point clear?
Yes, sir.
So for example, let's say in this scenario, company A is designated as the representative of the tax group. Then company A will be responsible for everything. They will make sure that the returns are filed in a timely manner, non-compliance does not happen, etc., etc. And if either of the companies provides transaction to a third company, let's say outside the tax group, company C, so it will be seen as if the tax group has supplied. it is deemed to be supplied by the representative group, then the seller will be seen as company A because that's the representative company of the tax group. Okay. Now, voluntary registration. So, any person not obligated to mandatorily apply for tax registration may voluntarily apply for tax registration if the person number A article A, proves at the end of any given month that the total value of the supplies or the expenses which are incurred during the previous 12-month period exceed the voluntary registration threshold, or at any time the person anticipates that the total value of supplies or the expenses will exceed the voluntary registration threshold in the next 30-day period. Okay. And what is that registration threshold? Uh, Voluntary registration threshold is 187,500, which is half of the mandatory threshold. Now, Mohan, your original question, deregistration also comes. Tax deregistration states that registered person can apply for the authority. Actually, it should not be can apply, it should be has to apply or must apply to the tax authority for tax deregistration if the person ceases making taxable supplies or value of the taxable supplies made over a over a period of 12 consecutive months is less than the voluntary registration threshold. Is this point clear to you guys?
Yes, sir.
And
Yes.
it is not can. This
Must.
is a wrong word. Can
Shall.
apply.
Must
Shall
apply.
apply. It should be shall
Okay.
apply or must apply. Something like that. Because if you don't deregister at that time, there is a penalty, 10,000 dirham penalty. Okay, when discussing supplies, the date of supply, place of supply of goods, place of establishment, and agency should all be considered. Article 25, the VAT decree law shall be calculated to be due and payable on the date of the goods and services are supplied. So VAT will be calculated on the day of the supply, basically, depending on the circumstances that this date. So what are we studying? What we are studying is what is the time of supply. Okay, timing of supply. Place of supply is a different topic. Time of supply is different. So what is the time of supply? Various criteria have been identified. The date on which the goods were transferred, if such transfer was under supervision of the supplier. So what was the date on which the goods were transferred? Or the date on which the recipient of goods took possession of the goods if the transfer was not supervised by the supplier. Two different scenarios, right? One scenario is under the supervision of the supplier, and the other scenario is that the supplier was not supposed to deliver the goods. Buyer was supposed to come and pick up. This is a second scenario. So when did the buyer actually come and pick it up? That will be the date of supply. But in case of purchases from Amazon or Temu or etc., because they are responsible for supplying the goods as well, right? So it will be under the supervision of the supplier. The date on which assembly or installation of goods was completed. So certificate of completion, where the goods are supplied with assembly and installation. The date on which goods are imported under the custom legislation. So custom clearance will come into play. On which the recipient of goods accepted the supply, or the date no later than 12 months after the date on which the goods were transferred or placed under the recipient of goods, if the supply was made on a returnable basis. So, you know, the date on which the recipient of the goods accepted the supply, or on a date no later than 12 months after the date on which the goods were transferred or placed under the recipient of goods, the one who's receiving the goods, sale or return basis. So in Carrefour, in some other, Union Co-op, etc., sometimes goods are supplied on sale or return basis. So, the date of supply will be either the date on which the recipient of the goods has accepted the supply, or if the goods are just lying on the shelves, uh, then there's a 12-month period allowed within no later than 12 months after the date on which the goods were transferred or placed under the recipient of goods. So if that is this criteria is for those sales which are on returnable basis. The date on which the provision for services was completed. Provision of services was completed. In this case, you are doing a consulting contract, for example, and that deliverable was provided. The date on which the deliverable was provided, that will be the date of completion. So that will be the date of supply of goods, supply of services. Or last one, date of receipt of payment or the date on which the tax invoice was raised. So it can also happen that the payment came first. So earlier of these dates. So as you can see, earliest of these dates. So let's say you went to the tailor and you paid the money right there on the spot. Tailor did not even issue you the invoice yet. He said, okay, you go home, I will send you on WhatsApp, right? So the that day on which you made the payment already, that day will be seen as the supply of goods. Clear, guys? Article 27 covers the place of supply of goods, which is important when determining whether tax is payable. Why is it so important? Uh, Multiple reasons are there. So whether you have to pay the tax in this period or the next period, this especially on the cutoff dates, it can create challenge. If supplied outside the UAE, then the UAE may not then UAE may not be payable. UAE VAT may not be payable unless the place outside the UAE is in a GCC member state. So sometimes you have supplied the goods out of UAE, but to Saudi Arabia. In certain cases, the customer will still need to pay the tax. Although this is an export of goods, exports by default are zero rated. But in rare circumstances, if the person who's buying the goods is there in Saudi Arabia and certain other conditions are met, then that customer will have to pay for VAT. So in the UAE, out of the UAE, let's have a look at it. That is, the place of supply of goods shall be in the UAE if the supply was made in the UAE and does not include export from or imports into the UAE. So the place of supply will be in the UAE if the supply was made in the UAE and does not include exports or imports into the UAE. For installed and assembled goods, if exported from or imported into the UAE, the place of supply shall be in the UAE. So you're installing the goods or assembling the goods. The place of supply shall be UAE if the assembly or installation was done in UAE. Or it will be out of UAE if the assembly or installation of goods was done out of UAE. So where was the assembly performed? Where was the installation done? These questions will define whether the place of supply is UAE or not. For goods which were exported or imported, the place of supply shall be inside the UAE in the following instances. If the supply includes exporting to a place outside the GCC member states. So you're not supplying to Saudi Arabia or Oman, you're supplying to somewhere else in Africa or other places. Then the place of supply shall be considered as UAE and it will be considered as a zero rated transaction. Why? Because this is export. If the recipient of goods is in a GCC member state is not registered for tax. So the person who's buying, he is not even registered for tax. Still, the supply will be seen as supply in the UAE and it will be considered as export, state of destination. And the total exports from the same supplier to the UAE do not exceed the mandatory registration threshold for that state. A total exports from the same supplier to the UAE do not exceed the mandatory registration threshold for that state. So like a Saudi supplier was providing the goods to a UAE customer, and in Saudi the registration threshold again is 375,000 Saudi Riyal. So if it does not exceed 375,000 Saudi Riyal, then no problem. Then it will the person will consider it as exports. But if it exceeds the registration threshold, then that Saudi supplier will also need to register in UAE, and they will need to raise a tax invoice. The recipient of goods does not have a tax registration number in UAE. Recipient of goods is a consumer. They are not even registered for VAT. And the total exports from the same supplier in an implementing state to UAE exceed the mandatory registration threshold. What were we studying? For goods which were exported or imported, the place of supply shall be inside UAE in the following instances. So what we are saying is the place of supply shall be UAE if these scenarios exist. So last scenario that we saw where the place of supply shall be UAE was recipient of goods does not have a TRN number in UAE. So and the total exports from the same supplier in an implementing state exceed the registration threshold. So a Saudi supplier is selling to Ramsha, for example. Okay, she is not registered for tax in UAE with the FTA for VAT, right? And the Saudi supplier keeps selling her, and that the total annual sales from that supplier exceeds 375,000 Saudi Riyal. Okay, then what will happen? Then the place of supply shall be seen as UAE. What happens if the place of supply becomes UAE and the registration threshold is also exceeded? That supplier has to now register for VAT. Is this point clear?
Yes.
Mohan, did you understand what I just said? Mohan, are you
Sir,
there?
yeah.
If it is not clear, ask me why.
Yeah.
This point is clear.
Yes, sir.
Okay. Place of supply and residence. There are also differences between place of supply of services in special and non-special cases. Okay, let's have a look at the place of supply of services in non-special cases. Place of supply of services shall be the supplier's place of residence. This is non-special case. Supplier's place of residence. Okay. Place of supply in special cases. In certain circumstances, the place of supply shifts to the customer's place of residence. Unique situation. Like, let's say Mohan is receiving some services, okay, from one of the countries. So, this is import of services into UAE, right? So, if it is a non-special case, then this supply, uh, the place of supply will be considered as the supplier's place of business, not Mohan's place of residence. But if it is a special case, then the place of supply will be considered as Mohan's residence, which is UAE. Example, further discussion on this. If recipient of services has a place of residence in another GCC member state from Saudi Arabia, recipient of services, customer, client, he is living in Saudi Arabia and is registered for tax in Saudi Arabia. The place of supply will be the place of residence of the recipient of services. In that case, place of supply will become Saudi Arabia. Mr. Mohan is, let's say, teaching accounting or tax to someone who lives in Saudi Arabia. Okay. And that someone is actually registered for tax in Saudi Arabia. Then this place of supply will be will be considered as Saudi Arabia and not UAE. Is this point clear, Mohan?
Yes, sir.
Okay. If the recipient of services is in business, and has a place of residence in the UAE. Okay, one person was receiving services and was living in the UAE as well, and the supplier does not have a place of residence in the UAE. The place of supply shall be in the UAE. What happens if the place of supply becomes UAE? Then the person who's receiving the supply has to record reverse charge mechanism, RCM. So, have you heard about reverse charge mechanism, Mohan?
Yes, sir.
What is RCM?
Reverse charge, suppose we are importing services or goods from other countries,
Hmm.
then we will charge. They will charge a reverse charge mechanism. Just will show in books. We no physical payment on that.
Okay.
Import,
That's not
import services.
import of services. So if you are importing services, so that supplier is living in China. Can UAE recover tax from him?
Yeah.
No.
No, sir.
So what does the UAE say? UAE says, look, there has been an import of service. We need our taxes. Okay. So if the supplier is not going to pay us, then the customer should pay us. Is this
Yes.
point clear? That is reverse
Yeah.
charge mechanism.
But
Yeah.
okay.
Yeah. No, Mohan, you have a question. Ask away. See, in case of reverse charge mechanism,
Imports. There is a tax on imports, sir. Imports goods and services in
yeah,
UAE.
absolutely, yes, absolutely. So goods is easy because goods will enter from a port. It can be a
Okay.
seaport, it can be a
Yes,
land port, it can be airport, right?
Yeah.
So the goods is easier because there will be a clearance required for the goods. Customs will say that clear the goods.
Yeah.
You can catch
Yes.
the goods, right? But what about services? Services are not provided through seaport or airport or land port. Services they can be provided over internet also. How will FTA control that? So what FTA does is that they ask the recipient of services, for example, let's say Ramsha is living in UAE and she is receiving services from Pakistan. Okay. So under the self-assessment mechanism, Ramsha has to record the input VAT herself, provided that Ramsha is registered for VAT. Okay, she has to record it on self-assessment basis. FTA will never find out. If she wants to commit an omission, intentionally, willfully not recording, she can do that. But then this will be seen as tax misreporting. She has to record the import of services and the tax she has to calculate, and she has to book that tax under the reverse charge mechanism. So input tax payable to the authority, like that. She has to book it.
Sir, one question, sir.
Yes.
See, I'm in UAE dealer, and I'm importing goods from other country out of UAE, and I'm exporting same goods to out of country, like trading.
Okay.
That time I have to pay VAT or how, sir?
If you are
Because
importing goods
I'm
into
importing from Oman, I'm exporting to Qatar.
Okay. So if you're first of all, if you're importing goods from Oman, then first thing is that you have to charge RCM on those goods, reverse charge mechanism.
Yes,
Okay, and those goods will not be cleared by the customs authorities unless you have booked the VAT. And by the way, you don't need to pay at that time.
Yes.
This will start appearing in your tax return automatically.
Yes, correct.
Right? So you have input tax payable appearing in your return.
Yes, sir.
How much amount of that input tax you can recover? for that you have to do an analysis. If you have any
Okay.
exempt income, then a proportionate amount of that input tax you cannot recover. It is called blocked input VAT or expensed input VAT. Okay. Rest of the input VAT you can recover. Is this point
Okay.
clear?
Yes.
Okay. In relation to supply of services related to goods, such as the installation of goods supplied by others, place of supply shall be where the services were performed. So if you have imported the goods and you're installing the goods or assembling the goods here in UAE itself, then the place of supply shall be UAE. Okay. See, you imported the goods and further re-exported the goods. Then that is that case you have to first of all book the reverse charge mechanism. You will not book, automatically FTA will book it for you in your return. After that, when you sell the goods, then sales can happen in any way. You can export the goods, you can supply the goods domestically. Either case, with the appropriate tax rate, you will be able to collect tax from customers. On domestic supplies, you charge 5%. For exports, you don't charge. These are zero rated. So you will have to identify how the exports and local supplies, and if there were any exempt supplies. So to the extent of exempt supplies, you will not be able to recover input VAT. Okay. Uh, for the supply of means of transport to a lessee who is not a taxable person in the UAE, a lessee, see, lessor is the one who owns the goods and gives it for use. Like a car, as we mentioned, or lease of an apartment or an office space, for example. Here we are talking about means of transport. For the supply of means of transport, for example, car, for example, taxi, to a lessee who is not a taxable person in the UAE. So an individual customer and does not have a TRN in a GCC member state. Okay. The place of supply shall be where the means of transport were placed at the disposal of the lessee. So if you are providing that in UAE, then the place of supply will be UAE. So that's an easier way to remember this. Means of transportation. Okay. And what is the next one? For the supply of restaurant, hotel and food and drink catering services, place of supply shall be where the services were actually performed. So if it is a hotel, that hotel will be the place of supply. And naturally, I mean, if restaurant, hotel, etc., they are usually physical. They are here in the UAE, so place of supply will become UAE. For supply of cultural, artistic, sporting, educational or similar services, place is where the services were actually performed, right? So concert is happening, artistic services, right? So where the concert has happened, that will be the place of supply, meaning UAE. For the supply of services related to real estate, as specified in the executive regulation, the place of supply shall be where the real estate is located. So facilities management company, for example, cleaning services. So where the building is located, that will be the place of supply. For the supply of transportation services. So what is the difference between means of transport? Where is that? Yeah, means of transport and transportation services. What is the difference? Can somebody tell me what is the difference?
Means of transport can be like air transport, like aircrafts, or
Planes
even the
can be
road
there,
land transport.
ships can be there, cars can be
Yeah.
there, which a person would like to use for himself, right? Instead, but transportation services, the best example is Dubai taxi, RTA, etc. Right? So that is supply of transportation services. The place of supply shall be where the transportation starts. So if you are doing a long distance journey from UAE to Saudi Arabia, you're going on Umrah, for example, right? So the place of supply will be from where the transportation service starts. If it starts from UAE, the place of supply is UAE. If it starts from somewhere else, the place of supply will be that country. The executive regulation shall specify the place of supply for transportation services if the trip includes more than one stop. So place of supply shall be specified by FTA if it is a multi-destination journey. Now we are coming to place of establishment and agency. So Article 32 of the decree law talks about place of establishment. Determining where the supplier or recipient is established is a complex matter. Place of residence of the supplier or recipient of services, residence of the supplier or recipient of service is the state in which the person's place of establishment is located. Okay. Place of residence of the supplier recipient is the place of establishment or located or fixed establishment branch is located, provided that he does not have a place of establishment or owns a fixed establishment in any other state. So this we discussed. Place of residence by default means these two things, like place of establishment and fixed establishment. Same thing has been repeated here. Okay. The state in which the person's place of establishment is located or where he has fixed establishment is the state that he is most closely related to. If he has a place of establishment in more than one state or has fixed establishment in more than one state. So, how, like one person has a company registered in UAE as well as KSA, you can register the same company. So, place of establishment is located where the person is most closely related to. Okay, so if the person lives more in UAE, then the place of establishment of that company will become UAE. The state of supply is the usual place of residence of the person. So this is what the key criteria is. So state of supply will become the usual place of residence if the person does not have a place of establishment or fixed establishment in any state. So that's that's a tricky part. Okay. Uh, this has been addressed in the double tax agreements as well. Place of vital economic interest, a place of primary abode. Abode means living. Place of primary place of living, basically. We note that in determining the state of the place of establishment, that the place establishment means the place where the person is legally established in a country pursuant to the decision of its establishment, certificate of incorporation basically, in which significant management decisions are taken or central management functions are conducted. So the company is governed from that place. We also note that fixed establishment means fixed place of business other than the place of establishment, which is incorporation, in which the person conducts his business regularly. So that includes the person's branches also. So that was all about place of establishment. But what is agency then? Place of residence of an agent is the place of residence of the principal. Agent is only acting on behalf of the principal, right? So where agent lives, that's not important. Where the principal lives, that's important. If the agent regularly exercises the right of negotiation and enters into agreements in favor of the principal or maintains a stock of goods to fulfill supply agreements for the principal regularly. So if the agent is maintaining stock of goods or he exercises the authority regular basis, then then the place of residence of an agent shall be seen as place of residence of the principal. That's a very interesting article. Please understand this well. Even if the person is living in UAE and the principal is out of the country, then the place of residence shall be seen not as the place of residence of the agent, but that of the principal. Any confusion up till now? Okay. Now we are going to discuss zero rating and exemptions. So what in your view is the difference between zero rating and exemption? Can somebody tell me?
Zero rated means under VAT it is taxable goods, but rate it will be different and exempted fully like that, excluded from VAT.
Okay.
Exempted.
Ramsha, would you like to say something on this?
Yeah, exempt goods are like the ones that are exempt from tax, and zero rate goods come under taxable goods, but there's a threshold, I
Okay,
believe.
recoverability of input tax. From that perspective, can you give me the answer? Can we recover input tax for exempt goods?
No, we cannot.
We can recover input tax only for either zero rated goods or
Normal good.
Normal goods.
what do you call normal good? There is no such terminology as normal goods in VAT. Standard rated goods.
Standard rate.
Standard rated supplies. Don't say normal. Say standard rated.
Yes.
Clear?
Yes.
Yeah.
Zero rate shall apply to direct or indirect exports to a place outside all of the GCC member states. So this is a crystal clear concept. Leave the 6 states. Other than these 6 states, if you are supplying goods, then this will be considered as export and it will be zero rated. That's the easiest for us to remember. Is this clear up till now?
Yes.
Yes, sir.
Okay, that's the first point. International transport of passengers and goods which starts or ends in the UAE or pass through its territory, including transport related services. So if there is an international transport of passengers and goods, international transport, which starts or ends in UAE or even passes through the territory, including transport related services, then it will be eligible for zero rating.
Zero rate.
Okay. Any passenger transport in the UAE, if it is considered an international carriage, uh, pursuant to Warsaw Convention for unification of certain rules for international carriage. So, if there is an international transport or transport related service, that will also be zero rated. Supply of air, sea, and land means of transport for the transportation of passengers and goods. So, means of transport, meaning aeroplanes, ships, boats, or trucks, cars, etc., means of transport. For the transportation of passengers and goods, if you provide any of these things, they are also zero rated. Okay, these are all examples of zero rate. Supply of goods and services related to the supply of the means of transport mentioned and which are designed for the operation, repair, maintenance, or conservation of these means of transport. So, there are ancillary goods and services, right, for the means of transport, lubrication oil, cleaning, maintenance supplies, like that. So, if there are ancillary, goods or services to the means of transport, they will also be zero rated. Supply of aircraft or vessels designed for rescue and assistance by air or by sea. All the rescue vessels, their sales or supply or right of use, that is also zero rated. Supply of goods or services related to transfer of goods or passengers aboard land, air, or sea means of transport. So, supply of goods and services related to the transfer of goods and passengers aboard land, air, or sea transport. So if you're traveling in Air Arabia and they bring meal for you and they charge money for you, that will be zero rated or standard rated? हाँ भाई, Mohan?
You come again?
Supply of goods or services related to transfer of goods or passengers aboard land, air, or sea means of transport. भाई means of transport मतलब aeroplanes, right?
Yeah,
And what is that aeroplane transferring? Goods or passengers? So Ramsha and Mohan and Jaleen, right? So you guys are sitting inside an Emirates Airlines carrier going
yeah.
somewhere, okay? And then on that aircraft, you have been supplied some goods and services, and for that they have charged you money, right? So they will bring you a tax invoice, right?
Yeah.
Emirates Airline. That tax invoice will be zero rated, standard rated, or exempt.
That would be zero rate.
That will
Zero,
be zero rated, because
zero
this is
rate.
yes, this is an example of zero rating of goods and services. Okay. The supply or import of investment prescribed precious metal in prescribed investment in prescribed precious metals. Some precious metals have been prescribed. If you supply or import such investments, then that will also be zero rated. So some metals have been specified. Also zero rated of the first supply of a residential buildings within 3 years of the completion. So let's say a residential project is being launched in Danf, one of the real estate developers in UAE. The project's name is, let's say, Najm 1. So we start selling the apartments in Najm 1 project. Okay. So until how many years can we charge zero rate on the first supply of those apartments? Until
3 years of completion.
until 3 years. After 3 years, if we again make a first supply, will that be zero rated? So the project is completed today, or let's say a few days back, 20 days back, 31st January. Okay. Najam 1 project completed and we started the supplies, selling the apartments. Okay. In Dubai. So that's a residential building. Okay. Not commercial buildings, but residential buildings. We have to raise tax invoices for that, right? Those tax invoices will be zero rated. Until which year we can raise zero rated invoices? Starting from February 2025. Until when? 2026?
27.
28,
26, 27, 28. 3 years.
28.
What will be the last date of zero rated invoices?
31st to January
March.
2028.
Correct. 31st
31st.
January 2028. Until that day, we can raise zero rated
Zero.
invoices if we sell any apartments in Najam 1 building. Is this point clear? Okay,
Yes.
one sale is happening and it was a very, let's assume it was a bad project, nobody purchased it. And some apartments are still available for sale. And one of the apartments was sold in the month of February 2028. Now tax invoice has to be raised. What amount of tax are we going to charge? Zero rate or something else? February 2028.
Actually, sir, in when, that definition of residential building, it's flat wise or building wise, sir?
Residential, no, residential buildings, supply of residential buildings. So it can be apartments also. Buildings will cover apartments, villas, whatever it is. Anything that is a residential building.
Residential
Which are
building means
standard rate.
including it will first supply that flat only. We are the first supply, na, sir. Building already some plots are already sold, na. That's why I'm
By
asking
building
that.
to it is constructed, na. Building is constructed by the developer. Developer
Yeah.
owns the building. Okay. Developer owns the building. Developer has constructed the building. He's selling the different apartments inside the building. So the developer is making a
Then,
sale in the
then
month
it
of
will be
February.
zero rated, sir.
In the month of February 2028, bhai. In the month of February 2028.
That flat giving first time only, na, sir. First supply only, na.
Yeah, but it is said here that the first supply will be zero rated until 3 years. After that, we can confidently say that it can be anything but zero rate. So the answer is that in February 2028, if we sell or rent that building, that apartment, it will not be zero rated. Now the question is, what will it be? Will it be standard rated or will it be exempt? I want you guys to hold this question. This answer will come.
Residential building means it's exempted.
Yes.
Exempt.
It will be exempted. We will read that later when we read the exempted. Okay. So if you sell for the first time an apartment that was never sold, it was a first supply, and 3 years passed, and after 3 years you sell, then it will not be zero rated. Ramshad, is this point clear?
Yes.
Okay. Or buildings specially designed to be used by charities through sale or lease. So if there are buildings that are designed, developed by charities or sale, they're also zero rated, and there's no 3-year embargo here limit. Or buildings converted from non-residential to residential through sale or lease. So if you have buildings that were originally non-residential, commercial, but they were converted to residential, then then again it will be zero rated. Also zero rated is the supply of crude oil and natural gas. The supply of educational services and related goods and services for nurseries, preschools, school education and higher educational institutions owned or funded by the federal or local government. Is this point clear?
Yes.
Can any and all schools claim that we are supplying zero rated services, or will they pay VAT? If a school is not owned by federal local government or funded by federal local government, can they raise zero rated invoices?
No.
Higher education institutions owned or funded by federal or local government. And the supply of preventive and basic healthcare. This is very, very important. Preventive and basic healthcare services and related goods and services. Let's say we have a dental clinic called GBT that is located in JBR in Dubai, and they are providing services to customers. What type of invoice will they raise? Will that be a standard rated invoice or a zero rated invoice?
Zero.
Zero rated invoice? Why? Supply of
Preventive.
or
In healthcare.
preventive or preventive and
Basic healthcare.
basic
Services.
healthcare. So
Yes.
where will it come? Is it preventive healthcare or basic healthcare, dental services?
Basic healthcare services.
Basic healthcare. So yes, that clinic will raise
But
zero
Miss
rate.
Altaf, not all the services under dental will come under basic healthcare because now there is cosmetology involved in that.
Exactly. Very good point. If it is not preventive healthcare, if it is not basic healthcare, then zero rating of the invoice will be wrong.
Mm.
There are multiple famous hospitals in Dubai Healthcare City, DHC, which are providing cosmetic surgeries, for example. Right? So do you think they can raise zero rated invoice? Cosmetic surgery.
No, it will be standard rated.
It will be
Cosmetic,
standard rated.
yeah,
It is not preventive or basic healthcare. It's cosmetic surgery.
yes.
Okay. Acha, okay. There are some companies who are providing medical equipment. Okay. They sell only medical equipment. They're not hospitals or clinics. They sell medical equipment. Will
Mm.
they raise zero rated tax invoice or standard rated tax invoice?
Standard,
Standard rated.
standard rated. Yes.
What about you guys, Ramsha, Mohan?
Zero
Hello.
rated
Zero,
Zero.
because that is
because it's medical related goods and services.
Zero rate.
All of you need to revisit your answer because on purpose I asked an ambiguous question. I did not say that the company provides preventive or basic healthcare related goods and services, equipment. I just said medical goods, medical
Mm.
equipment. So the answer is
It's equipment.
both.
Yeah.
It can again
Yeah, yeah.
divided
It
between
has to
zero
be
rated and
divided.
standard.
It has to be
Mm.
divided between the two categories. Preventive basic is one category and
And
other
basic, yeah.
cosmetics is other category. If it is not preventive or basic healthcare related equipment, then it will be standard rated. Otherwise, zero rated. Is this point clear?
There.
So, Article 30 and 31, it is being repeated what we read. Executive Regulation 30, Article 30 provides information on how to identify export of goods qualifying for zero rate. This is important. For a direct export, goods are physically exported to a place out of GCC, China, India, America, etc., or put into a customs suspension regime in accordance with GCC common custom law. There is something called a customs suspension regime where you don't pay customs. So if you put the goods into customs suspension regime within 90 days of the date of the supply of the official evidence, meaning export documentation issued by the local Emirates Customs Department, or of commercial evidence, for example, airway bill or bill of lading, etc., of the export or customs suspension is retained by the exporter. So this is basically, this will be export of service. If these scenarios exist, this will be export of services, it will be zero rated. Okay. Is this point clear first of all? Any question on this first point? First was example of direct export out of GCC. And indirect export. The goods are physically exported to a place outside the GCC member states or are put into a customs suspension regime in accordance with GCC law within 90 days of the evidence of the of supply under an arrangement agreed by the supplier and the overseas customer at or before the date of the supply. The overseas customer obtains official and commercial evidence of the export or customs suspension in accordance with the GCC customs law and provides the supplier with a copy of this, that this is the export that is happening. Or C category, goods are not used or altered in the time between the supply and export. So what happened in this second scenario? First point was goods were physically exported to a place outside the GCC member states they were either sent to the sent outside the GCC member states, or were put into a custom suspension regime in accordance with the law within 90 days of the date of supply under an arrangement agreed by the supplier and the overseas customer at or before the date of the supply. So you agreed with the customer that, okay, we are going to put the goods into a custom suspension regime. So within 90 days of the supply. And the overseas customer obtains official and commercial evidence of the export or customs suspension in accordance with the law and provides the supplier with a copy of this. So overseas customer obtains evidence and sends the copy to the supplier. The goods are not used or altered within in the time between the supply and export or custom suspension. The key point is the condition of goods should not change. No alteration or processing should happen, except to the extent necessary to prepare the goods, meaning small packaging has been done. No problem. Packaging is okay, cleaning, packaging, etc. The goods do not leave the UAE in the possession of a passenger or crew member of an aircraft craft or ship. If these conditions are met, this is an indirect export and it will still qualify for zero rating. Another scenario, authority may extend the 90-day period if the authority has determined after the supplier has applied in writing that either of the following apply. A, circumstances beyond the control of the supplier and the recipient of the good prevented or will prevent the export of the goods within 90 days. So some war happened, some COVID situation happened, and we are not able to supply the goods within 90 days of the supply. Due to the nature of the supply, it is not practicable for the supplier to export the goods or a class of goods within 90 days. So we actually supplied mangoes, but the agreement was that the mangoes will be ripe when they reach. And right now the status of the mangoes is that they have been plucked from the trees, but they are not ripe. They have been kept into a special type of container with where they by natural process they are going to become ripe because they have been plugged in a state where they can still get ripe after being plugged. So it will happen only after 90 days. Or another scenario, if these things are there, the authority may be convinced that, okay, we can extend the 90 days period. Okay, so it will still qualify for zero rating. If the person required to export the goods in accordance with this article does not do so within the period of 90 days or a longer period that the authority has allowed, tax shall be charged on the supply at the rate that would have been due on the supply if it was made in the UAE. If any of the things is violated above, then you have to apply tax on it. It will no longer remain zero rated. 5% tax will be charged on it. A movement of goods into a designated zone from a place in the UAE. From mainland, you are sending goods into Sharjah airport free zone, safe zone to Mohan. Or a supply of goods to a designated zone is not considered an export of those goods. So, or there is a special condition that this particular type of good will not be considered as export if it is specified as such. Then this will not be this will be a zero rated unless it is excluded, specifically excluded. Why? Designated zones are deemed not to be situated in UAE. Mohan, do you understand now what is the significance of a designated zone?
Yes, sir.
For VAT perspective, from a VAT perspective, designated zones when it comes to goods, supply of goods, designated zone is seen as situated out of UAE. So every day you go outside the UAE from a VAT perspective when you go to your job. Okay. So if you're supplying goods to a designated zone, it will be seen as export of services. Okay. And it will be zero rated. The evidence obtained as proof of export, whether official or commercial, must identify supplier, consignor, goods, their value, export destination, mode of transport and route. All of these information has to be provided. FTA may specify alternative forms of evidence according to the nature of the export or the nature of the goods being exported. One more thing, an indirect export includes a supply of goods in a departure area of an airport or port to a passenger of an aircraft or a vessel. So, if A, the goods are intended to leave the UAE in the possession of the passenger. So you just, one of the air hostess was your friend. You said, I'll give you something, please take it and give it to another person in America, for example. Okay. So that will still be considered as an indirect export. If you have already a plan that these goods have to leave UAE, okay, in the possession of the passenger. And B, supplier has obtained and retained evidence. Supplier has obtained and retained evidence such as the details of the boarding pass of the passenger. So maybe, I don't know, air hostess will be a good example or not, but another passenger, okay, and you obtain the boarding pass. Okay, this is the passenger from whose hand I have sent the goods, that the passenger intends to leave for a destination outside the implementing states. Okay, so boarding pass is there, evidence is there that this person actually went to America. So this will still be considered as an indirect export. Okay. For the purposes of this article, a supply of goods shall be subject to zero rate if goods that would otherwise have been exported are destroyed or cease to exist in circumstances beyond the control of both the supplier and the recipient of the goods. So you had organized, you had done all the arrangements for export of goods and it was meeting all the criteria for zero rating, but an act of God happened and the goods got either destroyed or they vanished, they ceased to exist, right? So FTA will still grant zero rating to such situations. Now we are coming to supply of exempt from tax, goods that are exempt. So what goods are exempt from tax? Let's read Article 42 of the Executive Resolution. So basically, supplies will be exempt if they are financial services, supply of residential buildings through sale or lease. Other than that, which is zero rated. Does this give you your answer, Mohan? Or other guys? Uh, After that Najam 1 apartment sale in February 2028 will be an exempt sale. It will not be zero rated. Remember this now? So three categories, A, B, and the C. Third category, supply of bare land. You're selling or supplying bare land, and supply of local passenger transport. Local passenger transport, that is also an exempt supply. Okay.
Mr. Altaf, I have a doubt here.
Yes.
In financial services, like what does it come under that? Because now we do give financial services, but we do charge standard rated on that, right? Invoices.
So to answer your question, financial services are services connected to dealings in money or its equivalent and the provision of credit and include all of this. Exchange of currency, whether affected by the exchange of banknotes or coins, by crediting or debiting the account, issuance, payment, collection, transfer of ownership of a check or letter of credit, issue, allotment, acceptance, endorsement of debt security, provision of any loans or advances, loans advances. It can be even from the parent company to a subsidiary or a related party to another related party. Renewal or variation of a debt security, equity security or credit contract. Okay. Renewal, these are also financial services. Provision, taking, variation or release of a guarantee, indemnity security, operation of current or deposit saving account, transformation of financial instruments such as derivatives, options, swaps, dealing in derivatives. All of this, payment or collection of any amount of interest, principal, dividend, or another amount, whether in respect of any debt security, equity security, or contract of life insurance. Even contract of life insurance has been put into financial services. Are these points clear? All of these are financial services, and all of these are exempt from tax. So what would banks do then? What is the biggest income of a bank?
Interest.
Interest income. So that means all of the income of the bank will be seen as exempt. Agreeing to do or arrange any of the activities above other than advising on one of the transactions, other than advising. So advising would not be exempt, but other than that, everything will be an exempt category. And what about Article 37? That is for the residential buildings. So again, it's a very tricky thing. We have to carefully understand it. What does residential building mean? A building intended and designed for human occupation. Building intended and designed for human occupation, including any building or part of a building that the person occupies, or that it can be foreseen that a person will occupy as their principal place of residence. Is this point clear? Residential building. Residential accommodation for students or pupils. Those, what do you call, mess, right? Students' mess. That's also residential building. Residential accommodation for armed forces and police. Orphanages, nursing homes, rest homes. What about labor accommodation? Answer may be here. A residential building does not include any place that is not a building fixed to the ground and can be moved without being damaged. So RVs, recreational vehicles, you know that? The moving houses on tires, right? Is that a residential building?
No.
No.
No. No.
Any building that is used as a hotel, motel, bed and breakfast establishment, hospital, or the like. Is that a residential building? No. Even hospitals, hotel, motel, bed and breakfast establishment. Serviced apartments for which service in addition to the supply of accommodation is provided. Have you guys seen the Golden Sands apartments in Bardubai? Anyone has seen Golden Sands? It's a big, series of apartment buildings, which are all residential in nature. Oh, sorry, which are actually, they provide residence. You can live in there, but these are serviced apartments. So, people come, they clean your room, change the bed sheets, they clean the toilets, everything, that's serviced apartments. So they are not residential buildings. They are still, their proper taxes charged. Any building constructed or converted without lawful authority. So if the building is constructed or converted without lawful authority, that will still not be considered as a residential building and it will not be exempted for tax. Any questions in what we've read up till now?
No.
No. Okay, fine. Okay, now we are coming to the reverse charge mechanism. So I think we discussed a little bit. Let's read from here. If the taxable person imports concerned goods, for example, goods that have been imported and would not be exempt, or concerned services in the state, for the purpose of receipt, then the recipient shall be treated as making a taxable supply to himself and shall be responsible for all applicable tax obligations and accounting for due date. My question here with Mohan. Mohan,
Yes, sir.
I have a question for you. Okay.
Yes.
So your company has an ERP software that is provided by an Indian company. Okay.
Okay.
And your company is also making some assumed exempt supplies. Okay.
Okay.
30% of your supplies, your revenue, comprises of those supplies which are exempt, assumed. Okay.
Okay.
Now, the ERP software, you have to pay a subscription for that. Let's say 100,000 dirhams per annum, just for discussion's sake. Okay. So when it's an import of service, right?
Yes.
So how will you record it in your books of account? What will be the accounting entry you will pass?
Like subscription charges to payment. Like
Subscript.
there is imports, there is no VAT, no, sir.
Okay. So
And reverse charge, it's
software as a service. ठीक है? Software as a service fee. So you are the okay 100,000. You have this is a situation that you have in your uh, company. Okay. Now SaaS fee is this ERP vendor account. Naturally, you will have to credit that, right?
yeah.
But is this enough? Is this the only entry that you will pass?
It will be
You are
reverse
importing,
charge.
huh?
It will be reverse charge. It will come, sir, here.
Yes. So what will be the reverse charge?
Like 5% on 1 lakh.
Okay. So I will do like this.
And it will be automatically credit also same entry, same reverse charge return it will come.
Okay. So I
Just book
credit it.
entry, it will be that is there is no payment, physically payment, the only book entry it will be there.
Hold on. Let's complete the entry. I'm going to ask you this question. Okay. So, okay, I'm going to change this to 200,000 to make it easier. Okay. So
Okay.
what name shall I give this debit?
Reverse charge for reverse charge on inputs, import.
Reverse charge RCM what?
RCM on imports.
RCM VAT on imports. Input है ना? This is input tax, right?
Yeah. Yes,
RCM input VAT. That's it.
yes.
Reverse charge mechanism RCM input VAT. Is it an asset?
This is
What is an asset? What is the criteria of calling something an asset?
this more than 1 year we can
More than 1 year we can what?
utilize that RCM, sir.
We can gain benefit out of that.
Yeah.
Economic benefits will flow to the enterprise up to the next 12 months at least, right? That's an asset,
Yeah.
right? So it is an asset because we will be recovering from this amount, right?
Yes.
So that is why I'm recording it as an asset. RCM input VAT
Yeah.
asset. What shall I
Yeah.
call this?
This we have to pay VAT to government because we are
Correct. So shall I call it RCM input VAT something else? There should be some name, right?
liability
Payable,
payment.
right?
Payable, yeah.
Okay, that was the first instance. Now I told you that taxable supplies are 70% and exempt supplies are 30%. Sorry. Your company has exempt supplies of 30%, right?
So this is normal sale you are telling, sir.
No, not normal. This is a scenario.
Okay.
I'm just creating a scenario. The company that is importing, this company which has a software, okay, uh, Okay. Now ERP affects everything, right?
Yeah.
So the company's total revenue is like this, right?
Correct.
This is the situation. Now tell me, at the time of filing of the VAT return, how much amount of input VAT can we claim? But
70% on that, sir.
at the time of filing VAT return, okay, what entry will we do?
RCM input VAT payable to.
This entire 10,000 will go away.
Yeah.
Yeah, am I right?
Yes.
All asset will be gone. So that means I will have to credit this entire asset. Am I
Yes.
right? The
Yes, sir.
credit column, right? Okay. What shall I debit?
RCM payable.
Do you agree with what I'm doing? We had some output VAT already collected, right?
Yeah.
So we will be offsetting against the RCM, against the output VAT, the amount of liability we had to pay. That's offsetting. No? Otherwise, we have to pay the full amount, right?
Yeah.
So how much will I? So this is the benefit. We had already some amount. Okay, let me remove so that it doesn't confuse you guys. I'll remove the VAT control account. Let's keep it simple. Output VAT account. We had output already in our, we had a lot of output VAT. So let me just for discussion sake, include the output VAT account as well. So company has, booked a lot of sales, right? So let's say, the company did 1 million amount of uh, the company did 1 million amount of sales, and company also had to charge VAT on it. Okay. So how much VAT company charged on this?
5%.
5%.
No,
So
no. Total supply 70%.
is this right?
Yeah.
70% of the sales was
Yes, sir.
taxable. On
Yes,
that,
sir.
they charge 5%.
VAT.
Am I right?
Yes.
So total amount of cash that they collected was the sum of these two things. Correct?
Yes. Yes,
This
sir.
was their sale. How much output do they have right now? Output liability, output VAT? 35?
35,000.
35,000. So they have ample amount of liability. So what will they do? Will they pay the entire 35,000 to the government authority?
No, they will adjust that RCM input VAT.
They have to adjust RCM input VAT, right? Correct.
Yeah.
So they have to do that. Let me paste it right like here so that it becomes easy from a visibility point of view. Okay, right. So now the question is how much amount I should write here. How much output VAT they can reduce so that they don't have to pay the entire 35,000.
Yeah, they have to pay 35,000 there. And again, RCM input VAT payable, we have to reverse now, sir.
No, so my question is, will they reverse the entire 10,000 RCM VAT?
Yeah, they can reverse, sir.
Ramsha, do you agree with this?
Because there is more.
If this is for the whole, like
This
that,
ERP affects the entire company. All accounting is being done in the ERP. It affects their taxable sales as well. It affects their exempt sale as well. It is supporting their taxable sales. It is supporting their exempt sales also. This ERP is supporting both. So how can you associate, how can you claim the entire input VAT asset? Some part of this VAT asset corresponds to exempt supplies.
But
So that's why I was asking this question, my dear. So what will happen is the total amount multiplied by that percentage which relates to taxable supplies. That's the amount you can claim. Now you
okay.
understand?
Yeah. But each and every time we have to calculate like this, sir.
Yes, we have to. We have to identify how much was our exempt supplies. And then we have to identify if we have a common pool. There will be expenses which are common pool expenses. So what should I
Like
write? What should I write for 3000?
each and everything.
Yeah, but you have to see when you're in a practical scenario, it will be easier for you. Right now, you're getting confused, thinking that how will we know what affects everything and what affect. So the answer is VAT recovery is a two-stage process. Input VAT recovery is a two-stage process. In the first stage, we allocate. In the second stage, we apportion. Do you understand the difference between allocate and apportion? Those input VATs
Yeah.
that directly and entirely relate to taxable supplies, we don't apportion. We simply tell that these are 100% recoverable. But those that relate to both taxable and exempt supplies, we separate them. We create a pool for them and then we apportion them. Understand?
Yeah. Mm.
Not clear, huh?
Sir, one doubt, sir.
Yes.
See, I'm in mainland. I'm in sitting in mainland, sir. Then I'll s- I purchase I imported goods from out of UAE, and I some sales I send sell here local,
Correct.
and some sales it will be export zero like exempted supplies I done.
Hmm.
But input tax credit, how I can input tax credit that time it will be more for me, na, sir.
So exact same manner you will claim the input VAT credit, my dear. If you imported the goods, you have to record how much amount of asset came, how much amount of liability you booked. It will be the same, exact same. But if you had exempt supplies, my dear, then you have to divide the asset into two portions. One portion will be recoverable portion, other portion will be, we also call it blocked input VAT. You understand now?
Okay.
So the remaining portion that we are not able to claim, that portion is known as the blocked input VAT or input VAT expense. This is loss for us. This we have to charge to our P&L account. That is why I created this example, because I spotted your misunderstanding of the RCM. When you were talking, I knew that you don't
Mm.
understand the concept well. That is why I have created this example. I hope now this is clear to you. See, those people who don't know VAT, they simply explain RCM in a very foolish manner. They say, at the time of import, we are going to create an input VAT asset and one liability will be created. And when we are about to file the return, this will be reversed. That's what they tell you. Am I right?
Yes, 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 yes.
But they are half-baked tax practitioners. They don't know VAT law. But the reality is that when you create when you import, you have to identify whether that import will support our both types of supplies, taxable and exempt supplies, or only exempt supplies, or only taxable supplies. I will tell you another very interesting point. Sometimes if you have paid input VAT that entirely corresponds to exempt supplies, then all of that input VAT will be blocked because that will fall under the allocation category. Allocate 100% to either taxable or exempt. Understand?
Okay. Yes, sir.
This is mixed pool. So this is how you have to make sure that you recover the input VAT appropriately. And what is the formula for that? Standard rated supplies plus zero rated supplies divided by total supplies. Understood? This is the formula multiplied by total input VAT for mixed use. So you have the total input VAT that you have in your books. You have to identify. You have to first of all segregate it into mixed pool and allocation pool. So that amount of input VAT which you can easily identify that this relates to taxable supplies. You don't need to do anything with that. You will claim it straightforward. That amount of input VAT which you can easily identify that it corresponds only to exempt supplies, you don't need to think too much about it. You will have to expense it out. But then there will be a third category of input VAT. That input VAT will be of mixed use nature. Only that you will have to apportion. Is this point clear?
Yes, sir.
Anybody else? Ramsha, did you
And
understand
sir,
this point?
sir, one more doubt.
Yes.
Just a trading company place sir, some total goods imported from out of India and total exporting, same export to out of this
No, I
country.
couldn't
Then
understand your question.
no, yeah, suppose I'm sitting, my company is in UAE. I'm importing goods from India. I'm exporting to US.
Hmm.
That time, whenever I'm goods importing from India, it will be RCM. It will be there, no, sir.
Correct. Yes, it will be.
Whenever I'm exporting time, I'm exporting to US.
Okay.
Same goods, extra. My margin I'm putting, I'm exporting to US.
Okay.
That time, how it will be situation?
That
Sir, can
that
you
time
explain?
your company will have a lot of fun. Why? Because your entire suppliers are zero rated.
Ah,
You will claim the entire amount of input VAT. You will
yeah,
charge zero VAT from the customer because you're exporting it.
yes,
So that is the best possible scenario.
okay.
Okay.
That time, full input, RCM full, I can reverse, na, sir?
Yes. At that time you can reverse full.
Okay, okay,
Okay.
okay.
Okay. So anyways, that was a little bit about RCM. Hopefully now you understand the accounting entries for how RCM is done. Okay. It's not, you have to apply logic to it and then recover RCM. You can't just blindfolded reverse the entry. Okay. You have to see how much amount of RCM asset applies to, corresponds to taxable, how much corresponds to exempt. This was a specific case where on purpose, I chose the example of an ERP which affects literally everything in the company. There are other examples. Okay. So in other examples, it may not affect. Okay. Like for example, um let's say you have uh, you've taken a guarantee, for example. Okay. Sorry, insurance coverage. You have taken insurance coverage for your entire loan portfolio as a bank. Mohan,
Yes, yes, sir.
what is the core business of a bank? Taking deposits and then extending credit, right?
Yeah, yeah.
So for the credit, what do you do? From credit, you earn what? Interest, correct?
Yes.
So what you did was you, as a banker, CEO or CFO, you reached out to an insurance company. You said, I want to insure my credit portfolio. Okay.
Okay.
So the insurer said, okay, fine. This much will be the cost. 100,000 dirham will be the cost for the insurance of your credit portfolio. Okay.
Yeah.
That 100,000 expense, and at that insurance service provider was sitting in USA. Okay.
Okay.
Export. Or not, it doesn't matter where he was. The point is that 100,000, will you be able to claim that 100,000?
No.
Why?
No.
Your company's 80% revenue or 90% revenue is exempt. Only 10% is taxable. Checkbooks, some fixed fee amounts. 10% of the revenue of this bank is taxable income. 90% is exempt income. So how much amount of 100,000 dirhams for the insurance?
10% only I can claim.
So you can claim 10% of the insurance.
Yes, sir.
What do you think, Ramsha?
Yeah, 10% because
What do
90%
you
is
think, Kalima?
10% itself.
All three are wrong. That insurance coverage relates to what?
Credit, yes. Related to credit.
And from that
rel-
credit, what were you earning? Interest in
interest,
Interest.
interest income. That interest income is what?
exempt,
So how can you claim anything from that expense, from that input VAT? Because that all falls under the category of this one.
Yes. Okay. Okay.
Get my point?
Yeah, yeah.
Don't just immediately apportion. First allocate. First see if you can allocate. And here it is a clear relationship, bhai. The entire insurance coverage relates to exempt supplies. Then why even thinking about apportioning? Now you understand, all of
Yes,
you.
sir. Yeah, yeah.
First allocate, then apportion. Okay. Anyways, so that was about RCM. When the final destination of goods entering the UAE is another GCC member state, when the final destination of goods entering the UAE. So goods are coming to UAE, but they are planned to be sent to, let's say, Saudi Arabia. Taxable person pays the due tax on the import of concerned goods pursuant to the mechanism specified by the executive regulation. So mechanism has not been explained. If a registrant, for example, a taxable person who has been issued with a TRN, makes a taxable supply in the UAE to another registrant, another registered taxpayer, uh, of any crude or refined oil hydrocarbons, and the recipient intends to either resell the purchased goods as crude or refined, or or use these goods to produce or distribute energy, then the registrant making the supply shall not charge tax on the value of the supply of the goods. What are we reading? Reverse charge mechanism. Then that registrant shall not charge tax on the value of the supply of goods. Uh, why was that the case? Was wait, let's read this. In the circumstances in which goods or services are imported into the UAE, the VAT law establishes a procedure to ensure VAT applies in the same way as it would apply if the supplier and recipient were both in the UAE. That's what the whole RCM is about. If the taxable person imports concerned goods, for example, goods that are imported and would not be exempt if supplied in the state, or concerned services, for example, services that uh, for the purpose of, then the recipient shall be treated as making a taxable supply to himself and shall be responsible for all applicable tax obligations. That was the concept of RCM we read just now. So the supplier is deemed to exist in the UAE. When the final, okay, this also we read that, if the goods are intended for another GCC state, then another mechanism will apply. And the third thing was that if a registrant makes a taxable supply in the UAE to another registrant, so domestic supply, one registered supplier makes supply to another registered supplier of any crude or refined oil, etc. And the recipient of the goods intends to either resell the purchased goods uh, or use the goods to produce or distribute any form of energy, then the registrant making the supply shall not charge tax on the value of the supply of goods. That registrant shall not charge tax on the value of the supply of goods, and the recipient of the goods shall calculate the tax on the value of the goods supplied and be responsible for all applicable tax obligations and for calculating the due tax in respect of such supplies. So that's a unique scenario, that the person who is making the supply will not charge tax on the goods, but the recipient will account for it. These crude and refined oil provisions do not apply where before the date of supply the recipient of goods, in other words, the person to whom goods are supplied, has not provided written confirmation to the supplier that his acquisition is for the purposes of resale. So in this scenario, one person, what was happening? One person was supplying crude, okay, or hydrocarbon, and the other person was going to use that hydrocarbon for either consumption or resale to another person. So in that case, the seller will not charge tax and the buyer will account for tax. But all of these previous two conditions will not apply if there is no written confirmation from the buyer that, look, I am buying this oil from you, so because I will resell it. This confirmation has to be provided. If he doesn't provide, then the previous conditions will not apply. Or where before the date of the supply, the recipient of goods has not provided a written confirmation that he is a registrant and the supplier has not verified the registration number. So he has to provide the evidence of registration, the buyer. And the third situation, where the taxable supplier would be subject to tax at the rate of 0% in accordance with Article 45. I think Article 45, I don't know what is that article, I think it is export, where the taxable supply includes the supply of goods or services other than the goods referred to in clause 3 of the article. So let's read, maybe they've provided, where a recipient of goods of any crude or refined oil, unprocessed or processed natural gas, confirms in writing to the supplier that he is a registrant, the supplier shall not be liable for calculating the tax. Supplier will not do, instead the buyer will do, the recipient will do, and he will record it as on an RCM basis. Recipient shall be liable for the calculation of due tax. So that's a unique scenario that applies only to hydrocarbons. So there is another Article 48 of the executive regulation that is also on reverse charge mechanism. First point, at the time of import, taxable person must be able to demonstrate that it is registered for tax. Okay. Taxable person should be registered for tax in order for the RCM application. Place of residence. Taxable person who has a place of residence in the UAE. Taxable person who has a place of residence in the UAE receives a supply of goods or services from a supplier who does not have a place of residence in the UAE, meaning a foreign supplier, and does not charge tax on that supply. The supply shall be treated as being concerned goods or concerned services. So basically, these are the worrying area for FTA. concerned goods or concerned services, meaning how will we collect tax on that? So that's where they put the responsibility on the buyer. Account for tax. The taxable person must account for tax on the value of goods. They should declare and pay the due tax within the return. Account for due tax, where the taxable person accounts for due tax under the RCM. They will keep the supplier invoice showing the details of and the consideration. So evidence has to be there. In the case of concerned goods, a statement from the relevant customs department showing details of the value of the concerned goods. So these were about importing. Any questions up till now? None? Okay, quickly. Designated zones is a topic we have discussed. Let me go through if there is, okay, this is better. Any designated zone specified by a decision is deemed to be outside the UAE. This is the key point for us to remember. Okay, Article 51 of the decree law uh, talks about designated zones. So they are out of UAE and outside the GCC member state, subject to designated zone being a specified fenced geographic area having security measures, custom controls, etc., having internal procedures regarding the method of keeping, storing goods, and operator complies with the procedures set by the authority. So if even if it is purportedly a designated zone, but the custom procedures are not being applied, then you should know that in that part of that designated zone where custom procedures are not applied, it will not be treated as designated zone. That area will not be treated as designated zone. That has happened in past in UAE. Where the designated zone changes the manner of operating or breaches any conditions based on which then the designated zone is deemed to be inside UAE. You understand this point? This is what I was telling you just now. Breach of the procedures. What more? The transfer of goods between designated zones is not subject to tax if both were where the goods or part thereof are not released and are not in any way used or altered during the transfer between the designated zones, and where the transfer is undertaken in accordance with the rules for the custom suspension common law. So in short, if you are sending goods from one designated zone to another designated zone, then this is an out of scope transaction. No tax will be charged on it. Understand? Because both designated zones are out of UAE. It is seen as a transaction happening out of UAE. What VAT to apply? Okay. If goods are moved from one designated zone to another, authority may require the owner of the goods to provide a financial guarantee for the payment of tax, which is that person may become liable for should the conditions for the movement of goods are not met. So there can be a financial guarantee requirement from the tax authority if you're moving goods from one designated zone to another designated zone. Okay, that's again a concerning point. Where a supply of goods is made within a designated zone. That's an interesting area, bhai. Okay, in safe zone, let's talk about safe zone. Mohan, you go to safe zone daily, right?
Yes, sir.
So how do you have your lunch?
Sometimes I'll take and go, sometimes outside hotel.
Outside. In a restaurant, right?
Yes.
That is situated in the designated zone, right?
Yes.
So when supply of goods is made within a designated zone to a person to be consumed by him or by another person, then the place of supply of those goods is deemed to be made in UAE. Do you understand this point?
Yes, sir. Yes.
So that will be a taxable supply, except
Yes.
when the purpose was to incorporate the goods into, attach the goods to, or that the goods become part of or are used in the production of another good in the same designated zone, and such good is not consumed. So in simple words, if the goods were consumed for producing another good, for business purposes, not for consumption purposes, then only it will stay in the designate. It will be considered as out of UAE. Otherwise, so consuming of goods, even that restaurant, they will buy merchandise, food items, right? And they will use those food items. So if they are preparing a dish, there will be multiple things, vegetables, oil, this, that. They will be consuming it, right? So can we call it processing and then consider that these goods are still outside of UAE? No, because you're preparing another thing, but that will again, it will be that is not consumed, it will be consumed. The finished goods will be supplied in within that restaurant. So easy interpretation is that even if you are processing anything inside the designated zone, the idea should be that ultimately we are going to sell it to customers, and it will not be consumed within the designated zone. The goods were delivered to a place outside the UAE, and the supplier retained supporting commercial or official evidence proving that the customs evidence proving that the goods were removed from the designated zone. And the C category, the goods were moved from the designated zone to a place inside UAE. So from a UAE perspective, that will be an import. And the supplier retained official evidence establishing that VAT had been applied on the import. So what happens if goods are moved out of designated zone and brought into mainland? How does that work, Mohan? Do you know what will the buyer do in the mainland?
Sir?
See, please understand something. There is a company in mainland who is your
Yes,
company's customer. Your
yes,
company is in safe zone.
yes, yes.
When the goods move out of safe zone, the buyer company in Dubai,
Yeah.
what will they do in their books of account? Will they record RCM?
Mm, Don't know, sir.
Think about it. When you sell those goods from a designated zone,
But
what kind of invoice are you going to raise?
we are selling to mainland means we'll charge VAT, no, sir.
You will charge VAT. A
Yeah.
company selling goods and sitting inside a designated zone will charge VAT.
No, if we are selling to our mainland means we have to charge, no, sir.
Who said that? Where a supply of,
We are sitting in designated zone, free zone.
and that zone is
We,
out of UAE, bhai.
oh, oh,
That zone is not in UAE.
yeah,
That's what
yeah.
I told you in the beginning. You every day
Yes,
you
yes.
go out of UAE,
Deemed to be UAE, deemed to be out of UAE.
deemed to be out of UAE. Where a supply of goods is made within a designated zone, that's a different scenario. But where is B? Uh, the goods were delivered to a place outside the UAE. So think about those situations where you raise an invoice to America, USA. What would
Okay.
you do? You will not raise a tax invoice. Why? That will be a commercial invoice.
Commercial invoice, yes, yes.
You will not even raise a tax invoice to USA. Why?
Yes,
Because you are not even a UAE company. Because you're sitting
yeah,
inside a designated zone.
yes, yes.
Although you will be a UAE company, but for the purposes of VAT law, you are
Yeah,
you
yeah,
are established out of UAE.
yes, yes.
So you will not even raise a tax invoice from designated
Commercial
zone.
invoice will raise,
You
yes.
will raise only a commercial invoice. But
Yeah,
what is more interesting is the goods were moved from the designated zone to a place inside the UAE, and the supplier retained the official evidence. Okay, what is this? Why did this clause come? What topic are we studying? You know what we are studying?
Designated.
yes.
Designated
Designated
zones.
zones.
We are studying designated zone, but see, article select we what I was trying to tell you was that the mainland company sitting in Dubai, do you know what they will need to do? They will need to record an RCM in their books. Reverse charge mechanism. You will not raise a tax invoice to them. You will raise a commercial invoice.
Yeah.
Because you are not, can you charge VAT on this transaction?
No, sir.
You cannot. You are a designated zone company and you are selling goods. You cannot charge VAT on this. Otherwise, the whole purpose of designated zone will fail. The whole idea of designated zone is that if a company sitting inside a designated zone sells goods, we should support that company. Okay, that's the whole this whole the free trade zone. World Trade Organization created all this for over the last many years. 30, 40 years this has happened. So free trade zone in all around the world, these zones are known as free trade zones. Here they are called designated zones. Okay,
Sir,
so
actually, free zone companies, they can sell goods to UAE mainland, sir, as per rule.
yes, they can. Otherwise, why would the Ministry of
Actually,
Finance,
as
who's
per me, free zone companies only, they will do only trading, like they
just tell
can,
me,
they can export.
just answer this simple question to me. What are we reading here?
Yeah, yeah, that's why I'm asking. It's,
This is corporate tax law, sorry, VAT law, right?
yeah, yeah,
Who issued this law?
UAE government,
Ministry of Finance.
UAE ministry, yeah,
So why would they write something illegal in their law? So what does that mean? Goods were moved from the designated zone to a place inside UAE to mainland.
yeah, yeah.
Does this answer your question?
Yes, yes,
And the supplier retained the official evidence establishing the VAT had been applied. So the place of supply of any service is considered to be inside the UAE if the place of supply is in the designated zone. This is a key point for us to remember. Treatment of designated zones from goods is entirely different and separate from treatment of services. Is this point clear to all?
Yes.
Place
Yes.
of supply of any
Any
service
service.
is considered to be inside UAE if the place of supply is in the designated zone. What does that mean? A software provider sitting inside Sharjah Airport Free Zone, if he provides services to anyone, what will be the treatment? Will he raise a tax invoice? By
Yes, because that
yes, because
would
this
be considered inside
ah
the way.
yes, because the place of supply will be UAE. Service treatment is different from goods treatment of VAT. The place of supply of any service is outside the UAE where shipping or delivery services are supplied directly in connection with the goods that have a place of supply outside the UAE. Okay, so place of supply of shipping and delivery services will be seen as outside UAE only when the place of supply of services is outside of UAE. Okay, some goods goods were being supplied out of UAE, then the related supply of services will also be out of UAE. Shipping or delivery of services are supplied by the same supplier of the goods. Shipping and delivery is also being provided by the same supplier who supplied the goods in the first place. Supplier of the goods is a non-resident person and not registered for tax. Chinese suppliers, American suppliers, Indian suppliers, Pakistani suppliers. Okay. And these goods are sold via an electronic sales platform, any type of online sales platform, including website electronic applications, which bring together third party sellers and buyers. Alibaba, best example. And through which goods may be sold and purchased. Has anyone purchased anything from Alibaba? When you make purchase from Alibaba, you will see that immediately after making a purchase from China, there are options of shipping agents. You ship your goods to the destination, and this will be the cost, etc. So that supply of goods is taking place outside the UAE, and so related services are also outside the UAE. Okay. And D, person owning the electronic sales platform is not the supplier of the goods. The person owning that electronic platform, that's only a platform, marketplace. That is not the owner of the goods. So I will tell you, you guys must have purchased something from Amazon, I'm sure. At least Ramsha, oh sorry, what Kalama may have, or Jaleen may have. Have you guys purchased anything from Amazon?
Yes.
Right? So if you have you seen that for certain goods, Amazon is the owner? Do you know that? They are sold on Amazon platform, but the owner itself is Amazon. So this D category falls here. The person owning the electronic sales platform is not the supplier of the goods. So those particular goods will be out of this article. Okay. So place of supply of any service is outside of the UAE, where the shipping or delivery services are supplied directly in connection with the goods that have a place of supply outside UAE. Example, Alibaba, purchasing from China. Shipping or delivery services are provided by the same supplier of the goods. So if Alibaba itself provides shipping and delivery of services, then only the place of supply will be seen as out of UAE. The supplier of the goods is a non-resident. So, all of these conditions will need to be met for the supply of services, shipping services to be out of UAE. Goods located in a designated zone in which owner has not paid uh, tax on will be treated as imported into UAE. Goods located in designated zone in which the owner has not paid tax on will be treated as imported into UAE if A, the goods are consumed by the owner unless they are incorporated into, meaning they have been processed to create another sellable good, or there is a shortage of goods like stolen or otherwise counted. So if that is the case, then those goods which are even located inside the designated zone, they will be treated as imported into UAE, and there will be a VAT to be payable on those goods. Any person established, registered, or who has a place of residence in a designated zone shall be deemed to have a place of residence in the UAE for the purposes of VAT. So, if a company is incorporated in JAVZA or safe zone, the place of residence of that company will be seen as UAE. The treatment of the supplies made is a different matter altogether. Place of residence will still be seen as UAE. Okay. Okay, now we are coming to taxation. After we have to finish this and then tax procedures. Oh boy, how much more is remaining? Quite a lot actually, and it has already been. So this is a big topic. I think we should divide it into two. Remaining we should do in the next lecture. What do you think, Mohan? Because we still have
Yes, sir.
even after that we will have another one. Tax procedures will be there.
Yeah.
Right? Yeah,
Yeah.
taxation. So there's a lot left. So please note until what we have studied, and we will start from this. We will be starting from 4. Okay,
Okay. So
VAT.
can you share this recording lecture, sir, please?
I
Particular
am
this
so
lecture.
sorry. The recording cannot be shared because of copyright reasons. So we don't
Okay.
share any recordings. But I mean, you can ask questions. You have the material available with you. If there are any concerns, you can always ask.
Okay.
Okay. Okay.
So full
Great.
syllabus, can you share, sir, one time, one full syllabus, like full module, 14 modules, what
Uh,
and all?
Sure. Let us go through that one by one because as we go, we are organizing these. So not all of them have been organized yet. So you've been provided until I think module 4. So gradually,
Oh,
the team is working on that to summarize, and I review and then I share with you. That's why
oh,
there are issues around that. That's why once we have completed that, then we will share. We don't want any copyright matters coming up. Okay.
Okay.
So, okay,
Okay.
great. Thank you very much, guys.
I have a doubt.
Yes.
In designated zone, like you said that transfers between one designated zone to the other will come as out of scope, then why is transfers within a designated zone not out of scope? I didn't understand that.
No, transfers within a designated zones are still out of scope. Who said they're not?
There you explained about the consumption.
No, so that's not a transfer. That's consumption.
Oh, no, it's like you purchase within the designated zone, and then do companies within the designated zone, they same designated zone, they purchase, and then when they utilize it, it's out of scope. It's not out of scope, right?
Yeah, exactly. So let's say
That
a company has, one company purchased some goods. Take the example of the restaurant itself. Okay. The restaurant requires a raw material, correct?
yes.
Yeah. So they will purchase it from somewhere, right?
Yeah.
So the vegetables, oil, etc., all of that, right? They will purchase from somewhere. Now, what choices do they have? They can buy it from mainland. They can buy it from the designated zone if there is a supplier available, right? So first step is to purchase from the designated zone itself. Now,
Yes.
right. So the seller of those goods is selling raw materials. They will be out of the scope because they are selling to another designated zone person, right?
Yes.
But once the restaurant takes purchases that good, uh, and their intention is very clear that they are going to consume those goods into making dishes and then sell to those people who come here and consume it.
Okay.
So that is the concept of consumption. Change it a little bit, make it a food company. Okay,
Yeah.
it changes. Because then they are supplying the finished products on an industrial level, and they are probably exporting it or otherwise, right? They are not acting as a restaurant. Then it changes. See, I'll tell you one company. What's the name of that company? It's a very famous company located in Javza itself. Uh, I think uh, 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 one name is Actia, I can remember, and there's another very famous company which produces all those famous cheese brands and food stuff, etc. See, they are preparing it at an industrial level and in bulk commodities. They're not like a restaurant. They will be treated as suppliers. The whole point of the article that we saw, the consumption, see, consumption is the last point where the goods perish. You understand what I'm saying? When we purchase something from, what do you say, from Carrefour, what do? We bring it to our homes and we consume it, right? Whether it is dress, textile, we wear the clothes. We buy and we eat it up, or cosmetics, we purchase and we consume it, apply it onto ourselves. That is the end user consumption. So basically, what was addressed there was end user consumption.
But myself of here, my doubt is, suppose like the restaurant or whatever they are preparing, they after that it's been sold inside the designated zone itself, right?
Correct. It is being sold inside the designated zone. And if that sales leg is the end user consumption, you get my point? If that sales stage is the end user consumption,
Mm.
only then that place of supply will be in UAE.
I am again confused. No.
I,
That means a transaction that's happening inside designated zone doesn't automatically become out of scope.
it has to meet criteria, yes. See, this is one example, na, restaurant. Take the example of hair salon as well, right? They are purchasing various goods, right? Electronic equipment or beauty salon. They are purchasing all of those goods from another supplier. It can be in designated zone, it can be out of designated zone. That will be a normal transaction. That will be considered as designated zone transaction. If they are purchasing, they will purchase through a commercial invoice. The seller will raise a commercial invoice because designated zone supplier is selling to designated zone customer. But when the
Yeah.
saloon provides that service to the end consumer, that's the last leg of it. After that, that service or good perishes. It no longer remains, or the scrap remains. At that stage, it will be treated as taking place in UAE.
Okay.
Understand?
In this case, Mr. Altaf, even when we are doing the same thing to other designated zone, also same criteria applies, right?
Same
Because
criteria.
yeah, okay, got it.
Yeah. Okay, guys.
Thank
Okay. Take care.